but still the fight for 25,000 continues between bulls and bears. If you look at the broader markets as well, there has been a little bit of a recovery. The India VIX from a high of almost 14 has cooled off a little bit, but all action will now move to the second half of trade, where the first half margin calls, as Nimesh pointed out, were taken care of. The second half is where the FII action begins. So where that goes is something we'll leave the team of Trading Hour to monitor and tackle with. Thank you for watching.
Stocks take a beating, with mid-caps bearing the brunt as Trump heads to Davos, where he may talk about Greenland. The Rupee too skids to a record low as investors root for safety.
The promoter group of Ajanta Pharma strikes a deal to take control of Burger King franchisee restaurant brands Asia, and Cupid seals an investment deal in bazaar-style retail, even as Zydus Life and Sun Pharma are seen making significant overseas acquisitions.
SRF slips as pricing pressure from Chinese rivals weighs. United Spirits dips as volumes miss the mark. Shoppers Stop is hit by weak consumption, while Vikram Solar sees orders and revenue slip sequentially.
Gold and silver surged to record highs as investors flocked to safe haven assets as geopolitical uncertainty could cloud global economic outlook. The sell America dollar trade and yen's dip on Japan's fiscal worries add to the mix.
The who's who of India's IT industry tells CNBC-TV18 they see a big opportunity in AI beyond making models in helping industry adopt the technology. But some express concern over the impact of advances in technology that can have on jobs. Good afternoon. Welcome to Halftime Report live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Ekta Batra and Vinny Motiwala. Hey girls, good afternoon. Well, today is the day we broke that 25,000 mark. The bulls and bears are fighting now because yes, we've recovered from those levels, but still it's a sharp cut that we're seeing from the highs of the day. In fact, now the Nifty is above that 25,100 mark. So the recovery has been quite swift as well. But across the board, it's a red looking screen. In fact, all the sectoral indices are in the red as we speak. So yes, it's a 540 recovery on the Midcap index, almost a 200-point recovery on the Nifty as well. But what happens in the second half is something we'll discuss in the show. The FIIs take control in terms of them waking up and starting looking at the Indian markets. But yes, a lot has happened already. But yes, there seems to be more.
Absolutely. There seems to be more. Do not forget, we'll have a lot of commentary that comes in from Davos as well when Trump lands there. But that is what is keeping the markets on their toes as well, right? That global uncertainty that still persists. And that is why that fall in the market is what we're seeing, the fall in the rupee that's come in as well. So that is a bit of a concern. And I would just like to see the advance decline ratio as of now. Where is that headed as well? Because obviously today we're seeing more stocks that are going to be in the favor of overall declines versus advances. And the gap is still wide enough, right? It may be a slight bit of a recovery, but doesn't seem to be a bit of a respite coming in, at least on the broader end of the markets.
Well, yes, absolutely. We've started the year on an extremely negative footing on a year-to-date basis. The Nifty is down around 4%. The mid-cap index has fallen 5.6%. The BSE small-cap index is down around 9%. So it's been extremely weak. The rupee, like we mentioned, is the second worst performing currency in Asia month-to-date. But nonetheless, let's kick off the show with Persistent Systems, which is in focus. It's reported what was a good set of Q3 earnings with the constant currency revenue beating estimates. Joining in to discuss more about the earnings is Sandeep Kalra, who's the CEO of Persistent Systems. Mr. Kalra, if you can start by explaining this AI platform and tools which driven pricing model which drove your margins this quarter.
If you look at the company per se, we delivered 4% quarter on quarter in dollar terms, 17.3% year on year, leading to $422.5 million. Now, within this, if you look at it from a profitability perspective, there were puts and takes. There was a one-time new labor code related impact, which is impacting everyone in the industry. The impact on our EBIT was 2.3% and on our PAT was 1.8%. Barring this impact, our EBIT would be 16.7%. Factoring this, our EBIT came at 14.4%. If we look at the PAT side as well, our PAT would have been outside of this 13.4%, and including this, obviously it declined and it came at 11.6%. Now, to your point, what you're looking at is the impact that we called out because of our AI platform impact in the quarter. Now, the way we are looking at the AI side of it is there are three legs to the stool. We are using AI for technology builders, where we are using our SASVA platform. And then there are two other platforms that we have built, iAura and GenAI Hub, which are basically aimed at the enterprise side of the house. Over the last several quarters, we have been seeding multiple relationships on the AI side. And we have had certain good wins, multiple of those in the last quarter and the quarter gone by, which are now ramping up. Now, depending on the nature of the deal, if we are using our IP and we are bringing in process improvements, we are implementing that upfront to be able to use lesser number of people to deliver the outcome. There are different, business models that we are bringing in, depending on what the customer also is amenable to, and that's what we called out.
Hi, Mr. Kalra. Good afternoon. So I just want to understand, so is it going to be pricing or AI productivity benefits that one will see? And will the adjusted EBITDA margins actually sustain at these 16-17% range levels?
2-3 parts to it. Number one, what we have done is this. Let me just go in a little bit more detail so that it's a little bit more clearer. When we have developed these platforms like SASVA or iAura or GenAI Hub, these are things that can accelerate. These are things that can, let's say you're developing an application or a product. They can bring in much more productivity with the same number of people. You can do much more using the technology. So for example, if you are doing application modernization, you're using AI to reverse engineer the earlier system, and then you're using AI as various forms, right from writing the requirements to converting that to technical to even helping the engineers code it better, faster, and so on, the full life cycle. That's what we are doing. And when we do that and we price that, we price for the total cost of ownership, including the money that we are charging for the IP and reusable components that we bring, and then obviously the manpower base. We don't differentiate that in certain contracts, and in certain contracts where the customer is amenable, like private equity organizations, where they are wanting to take upfront the charges, etc. So it will depend. So to your point, will it be an ongoing exercise every quarter? May not be. We don't want to give you any forward-looking guidance. All we can say is we have improved the profitability using this, and our endeavor would be to make sure that we remain in the 16 to 17% EBIT for the near future, and the rest we will keep investing back in the business.
Okay, no forward-looking guidance, but let's understand what the demand environment is like right now, Mr. Kalra. We are seeing a lot of geopolitical noise. Is that denting spending, ramp-ups as well from clients?
Yeah, so I think people are getting used to a noisy macro. And as far as we are concerned, our focus on building our capabilities, whether it is AI or otherwise, our focus on our top 100 customers, understanding what they are looking to do in their own businesses, we have had very good wins. If you look at our annual contract value, we won more than $500 million in the quarter. And from that perspective, look, we are seeing from our customers pretty decent traction. Now, macro is not in our control, but within that, how we react, we've done well, and we will endeavor to do well.
All right, sure. Constant currency revenue growth was strong at around 4.1% in what was a seasonally weak quarter, Mr. Kalra. What was the key driver, according to you?
Yeah, so look, the CC part will depend company to company. Our revenues predominantly are US based as of this point in time. We are roughly about 81-82% from the US, about 8.5% from Europe, the rest between India and Australia. That's broadly the mix. So, these currency movements that lead to this constant currency calculations, they are macro related things, nothing that we control.
Right. So, there's a step up in deal wins as well. So are you participating more in those large deal wins or more deals that you're looking at?
So look, if you look at our journey year on year, in the last 4 years, we have had a CAGR, the compounded annual growth rate of 25%, approximately. Now, what that means is, obviously, we have had a significant increase in revenues. If you look at our customer base, we have had significant number of customers go up in the different categories. So, for example, if you look at the greater than $75 million category, we have 4 customers today, as compared to lesser number many years back. Similarly, across board, whether it is greater than $5 million customers and so on and so forth. So as we have grown, as we have become more significant to our customers, we are being invited to bigger bids. And yes, we are winning bigger bids. And we are a significant challenger to our bigger peers in our industry. All of them are good companies, but we are winning unfair share of the wallet share from our customers. So that is what is leading to the growth.
Okay, so does that mean you're on track to achieve your aspiration of that $2 billion revenue by March 2027 and $5 billion by March 2031?
So first part, are we confident of our, achievement of our aspirations, etc.? We are on that journey. We will be on that trajectory, hopefully, and we'll deliver in the timeframes that we have said. We have said $2 billion by FY27, $5 billion by FY31. And we have also said there'll be a small inorganic component in the FY27, and we'll build it up. So from that perspective, pretty reasonably on that journey. FY27 looks good. We'll let the time pass by. And those are run rate basis when we exit the March quarter in 27. And we are putting the foundation for the $5 billion. And given our history, I'm pretty reasonably sure we'll try and achieve our aspirations on time.
Okay, all right, Mr. Kalra, we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's Persistent Systems. That stock down around 3.7% in what is a weak market. But what really stands out besides the equities is the rupee, which has hit a new low. We now have Dheeraj Nim, who is the economist and forex strategist at ANZ Research, joining in to discuss the levels that he's probably tracking for the rupee. Now, remember that the rupee is the worst performing Asian currency, or second worst performing Asian currency on a year-to-date basis, that is on a month-to-date basis in 2026 already. Dheeraj, hi, thank you very much for taking the time out. Well, 91.5, a lot of the Forex strategists were probably predicting this level, by mid or end of this year, but we're already at those levels. What's your sense in terms of what's driving this weakness, which is very sudden and severe, you would have to say?
Well, thank you very much for inviting me on the show. Look, I'm one of those strategists who were thinking that such levels would be achieved later in the year. But of course, directionally, we possibly have got it right that the rupee has a bias to weaken further. Now, technically, we are in an uncharted territory. 91.5 was our end FY27 forecast. But of course, with the current momentum, we think that 92.5, 93 could also be well within reach if the pressures remain. Now, what is leading to this weakness? I think it's a two-part answer. The first is, of course, outflows from the Indian markets have continued. Look, earnings season stress is quite visible, and also the global risk jitters around, the US-Europe tensions over Greenland and what happened in Japan. So the global cues also remain quite unsupportive of emerging market currencies, and the rupee had already been under pressure. But I think there's a bigger reason to reckon with here. And I believe this weakness had been brewing for quite some time, and it's not all of a sudden. Of course, such levels look sudden. But over the past few sessions, rupee had been gradually weakening. And I believe that is more to do with the real money flows, such as from corporate hedging demand and so on and so forth. Now, this to me is expression of the broader view that the rupee has a weakness bias, even at the current levels. Okay. Now, the bigger question is, why has the RBI not intervened? Because the last time rupee hit such levels, 91 and so on, they had come down rather heavy-handedly to bring the USD INR down. But I think since it is not to do so much with speculation, the RBI is tolerant of this rupee weakness.
Okay, so you're expecting no intervention coming in from the RBI in the next policy meet or even before that. We do have a lot of geopolitical events. We have Donald Trump who will be speaking today. So, of course, geopolitics is taking center stage. But any other domestic cues that investors should be watching out for that could impact rupee movement even further, Dheeraj?
Well, I think we're running into a rather busy time, even domestically here. Of course, earnings are going on as we speak, and they have been an important cue to foreign investors who've been rather disenchanted with the India economic story, which otherwise looks quite stellar, at least on the paper. Now, what we're also seeing is that the fiscal stress is becoming a theme as we discuss, the contours of the upcoming budget and what's happening at the level of states. So I think the budget season, as is usually the case, would also be a very busy one as far as the currency is also concerned. And then we head into the RBI. We do expect that, given the kind of tightness domestic liquidity conditions are experiencing currently, it is, of course, natural for the RBI to let go of the exchange rate a little bit more so that they can refocus on domestic liquidity situation, which to our analysis has become a bit concerning.
Sure. Dheeraj, that's on rupee, but also talk to us about the bond yields, right? Now, the Japanese bond yields also are soaring over there. We saw them move higher. How should we be looking at our Indian bond yields and overall bond yields?
Well, Indian bond yields have been under pressure for quite some time for a different set of reasons and not so much global cues. And several reasons. One, of course, includes the INR weakness and expectations of further INR weakness that has kept foreign bond investors, somewhat at bay. The second reason we've been highlighting is the increasing fiscal stress in the system, given the substantial shortfall in tax revenues and the government switch from fiscal deficit targeting to debt targeting in the upcoming fiscal year. There's generally a sense that fiscal consolidation efforts at the level of the general government and not just central government are going to slow down. Of course, we have the stress in terms of states' finances also playing out in the market. The third reason is, inflation, although is currently very, very low, it is expected to rebound. And that rebound can actually be also causing some upward pressure on the bond yields. So there are multiple factors, but for India, it's largely domestic. As far as the Japanese yields go, look, it is their fiscal situation, which has, and also, investors cutting down their losing trades that has contributed to the increase in the JGB yields. Fiscal situation more so because they have plans to cut taxes and raise spending, which have raised questions about the financial management of the government finances. Now, this is actually feeding into the broader environment of risk aversion globally, or risk jitters rather. But of course, what's happening in Japan and what's happening in the US have consequences for the rest of the world. But I would believe that at least Indian yields currently are driven more by domestic factors than global.
Okay, just quickly before we let you go, this target of or maybe this target that you have of 92.5 to 93, by when or what would be possibly the key catalyst that could possibly get us to those levels, and a timeline that you might have in mind?
Well, let me clarify at first. I'm not saying 92.5, 93 is my target. Currently, our target was 91.5, but as of today, we stand corrected on those levels. So we'll have to relook at our forecasts. But my sense is that unless we see a material acceleration in some of the domestic growth indicators in nominal terms, for example, nominal GDP, and unless earnings stress abates and there's some rebound happening there, the outflow story can very well continue. And insofar as net FDI remains a bit of a weak point and current account deficit risks widening in FY27, unless there is some abatement of trade frictions with, the rupee will remain very vulnerable to those outflows, and it could continue to weaken.
Take that point, Dheeraj. Thank you so much for joining in today with your thoughts at the outlook on rupee levels and what's driving the moves that we are seeing in the macro market. That's the word coming in on rupee, but we'll slip into a short break. As we do that, the countdown for Budget 2026 is underway. The most influential voices decode and analyze the impact on policy decisions from the finance minister. We bring you a power-packed lineup throughout January and on the day of the budget. Helios Capital Samir Arora for all things market, followed by JP Morgan Sajid Chinoy to discuss the macro signals. We also get you insightful analysis from industry veterans, and Dinesh Kanabar and Ashok Wadhwa for the tax rhetoric.
Welcome back to Halftime Report on CNBC-TV18. The markets have seen a significant recovery from the days at this point, whether you look at the Nifty, Bank Nifty, even the broader end of the market. That has seen a recovery now. 25,150 is what the Nifty is trading at. But a lot of stocks today are moving around in trade as well. Let's go across to Vivek to give us that list of passing stocks. Good afternoon, Vivek.
Well, good afternoon. What a sharp recovery we've seen, especially in the last half hour or so. Advanced decline ratio, which was very negative, just around 40-45 minutes back, has improved quite significantly. Individual stocks are what we are tracking. Eternal, ahead of the results, one of the top gainers as far as the Nifty is concerned, over 2.5% higher. Credit Access Grameen, a very good set of numbers. Asset quality has seen a sharp improvement, and credit cost too has improved almost 300 basis points sequentially. That stock higher by over 11%. J&K Bank, again, a good set of numbers. Loan growth quite strong at 18% on a year-on-year basis. That stock too doing quite well in the session. But a whole host of laggards today. First on the list is Kalyan Jewellers on very high volumes today. Stock down over 11%. The top NSE 500 laggard. The entire EMS pack, most of them seeing significant selling pressure on high volumes. So names like Dixon, Amber, PGL, most of these names are under significant stress today. Restaurants brand Asia, you did see the deal come about. Open offer coming in at a 10% premium to yesterday's close. It's been a very volatile session for the stock. Stock down almost 7% from the intraday highs. SRF again yesterday moved lower by almost 3.5% post the results. But today, on the back of slightly muted commentary on pricing, that stock lower by over 6%. And lastly, L&T Finance Holding was a sharp mover post results, but today has given up most of the gains and amongst the top mid-cap laggards.
Okay, all right, Vivek. Thanks very much for that. Well, significant recovery which has taken place in terms of the broader markets as well. So the mid-cap index is now just down 1% as compared to an over 1.5% fall when we started the show. So there's been a significant recovery which has taken place both for the Nifty as well as for the broader markets. We'll take a short break, but our in-house experts, Hormuz and Sonal, will give us their statistics and perspective on the broader market pain and what investors should watch closely on our What's Trending segment. Stay tuned. Welcome back. Well, let's focus on what's making news in our What's Trending segment. It's been a rough start to the year for the broader indices. The Midcap index is down around 5% this year already. More than 70% of stocks are in the red this month, with 11 out of 100 stocks trading at or near their 52-week lows. To break down what's driving this weakness and where the opportunities might lie, we have our in-house experts, Hormuz and Sonal, in the studio to give us their perspective on the broader market pain and what investors should watch closely. Hormuz, over to you first.
There has been some respite from the panic selling earlier in the morning, but this respite comes after a significant amount of pain that you have seen in the first 13 trading sessions of the year. And in just the first 13 sessions, the Nifty is down 4%, the benchmark index. The broader markets tell you an even deeper story. The mid-cap index is down 5%, the small-cap index is down 6.5%. And just to jog your memory back, 6.5% to 7% is what the small-cap index had declined in all of 2025. We have seen that fall in just the first 2 weeks of the year. Now, if you take a look at the number of stocks as well, there are down 10% or more. 4 Nifty names, 25 on the mid-cap 100 and 33 on the small-cap 100, which means almost 1/3 of the index is down 10% or more when it comes to the small caps. You take a slightly broader gamut of stocks on the Nifty 500, 430 names are trading with losses on a year-to-date basis. That's the kind of sell-off that you have seen in the broader markets. And if you break it down into the returns aspect as well, more than 11 stocks are down 20% or more, and at least 300 stocks are down anywhere between 5% to 20%. So it's almost 1/3 or 2/3 of the index that is down anywhere between 5 to 20%. Of course, that does not mean that everything is down. There are some opportunities as well. 7 names on the Nifty 500, predominantly being metal names, we'll talk about that in just a bit, are up 10% so far this year. Now you take a look at the underperformers. Tejas Networks was the worst performing stock on the small cap index last year. It's continuing that underperformance this time around. Cohance is down 26 as well. Godfrey Phillips, ITC, of course, because of the news flow that you got at the first day of the year, down 25%. It hasn't recovered from that. Nugent Software, after yesterday's move, is down 24%. Elcon Engineering is one such name as well. Disappointing earnings reaction, down 23% in just the first 2 weeks of the year. Now, if you take a look at the outperformers, most of these names are metal stocks. Look at Jindal Saw is up 14%. Nalco, Hindustan Zinc are up around 13% each. PSU banks have done well. Union Bank is up 13% as well. Emcure Pharma is one name that has sprung up in the list of gainers on the Nifty 500. That's up 12%. You go to the BSE 500, here too is no different. There's 425 names trading with losses. You break it down into a further returns aspect as well. More than 12 names or 14 names in fact are down 20% or more, and here too 290 stocks down anywhere between 5% to 20%, and 8 stocks have outperformed so far, returns of 10% or more, and most of those names are the ones that we just saw earlier. But here in the underperformers list, you look at Allied Blenders is down 30, CE Infosystems or MapMyIndia, much hyped IPO, down 25, HBL Engineering down 22, Signature Global, the entire real estate pack has been smashed so far in the first 2 weeks of the year. Sapphire Foods as well, down over 21%. So the indices are reflecting the pain, but when you break it down into specific stocks, the pain gets even larger in the broader markets.
Absolutely, it does get even larger in the broader markets. Thanks so much for that, Hormuz. But let's also focus in on mutual fund performances as well in 2026. And Sonal is here to decode how broader market is actually impacting these mutual funds. Sonal, over to you.
Well, at the outset, I would like to clarify that we should not look at mutual fund returns on a year-to-date basis or one-year basis if we are looking at long-term investments. But nevertheless, since we have seen this massive fall across the board, that is something that's seen in some of these small-cap and mid-cap funds as well. Just list them down. The LIC mutual fund has seen the biggest fall in last 1 year. Year-to-date, it's down 8%. Similar is the case with Motilal Oswal small-cap fund. We have Squant small-cap fund. There is James small-cap fund. Quantum small-cap fund is one of those which has seen lesser fall, 3.5% there. Sundaram small cap fund is the other one which has seen a smaller fall, or the fall is not as much as we are seeing in the benchmark indices. At the same time, Quantum and Sundaram are the two mutual fund houses that have seen a gain in the last 1 year. So they are not seeing massive cuts like the other mutual fund houses or the EMCs as well. Now, I looked at some of the holdings of the funds which have seen the biggest YTD fall. LIC Mutual Fund is that one. Apollo Microsystems is one of their holdings. Hormus spoke about Allied Blenders seeing a massive fall. That also is a holding in LIC Mutual Fund. There's Arvind Fashions, Naveen Fluorine, Precall, Shakti Pumps, Sirma SGS. This is one stock which has underperformed. So this explains the reason for underperformance in LIC Mutual Fund. Then I picked up Sundaram Small Cap Fund because that is one of the fund which has actually seen some return in the green in last 1 year. So wanted to talk about that as well. They have something like an MTAR Tech, there's Affle, a lot of IT and IT related companies there, RateGain Travel Tech, we have EID Parry, PNB Housing Finance and SJS Enterprises. If we talk about the mid-cap funds, the story is similar. Some of them have seen, most of them actually have seen year-to-date fall, but some of them have seen a gain as well on a one-year basis. So the names are the likes of HSBC mid-cap funds, Invesco India mid-cap fund, HDFC mid-cap fund has seen a 10% increase. We have Mirae Asset mid-cap fund which has seen a return of 10.5%. So mid-caps have not done as badly as small caps have done in terms of mutual fund performance. Let's look at Quant mid-cap fund because that has seen the biggest fall year-to-date. They have Aurobindo Pharma, Tata Com, Premier Energies, IRB Infra. Premier Energies did see a massive return during listing, but it did come off from those levels. HDFC mid-cap fund, which has seen 10% return in last 1 year, has the likes of Union Bank of India, which was an outperformer in Hormuz's list as well. We have Maxfin, Federal Bank, HPCL, which is up 30% in last 1 year. So some of the names which connect with the mutual fund holdings as well. Quickly, let's take a look at the cash holdings for a lot of these mutual funds. PPFAS again tops the list. They have 22% cash in their AUM right now as of December, followed by Quant. We have Vitalk at 12.5%. Even Motilal Oswal has 10% cash in their mutual funds right now. Trust Mutual Fund has 7.2%. HDFC, MF and Quantum also around that level. So yes, there are cash levels. Some of them have reduced it, but PPFAS continues to top the list with 22.5% of their holdings in cash as we speak.
Okay, all right. Sonal, thanks very much for that comprehensive breakup in terms of what's taking place for mutual funds. Just to put it into perspective in terms of the broader market pain for today, we have around 245 stocks on the BSE which are in lower circuit. We'll take a short break now, but Mangalam will focus on the F&O setup today. Stay tuned. Welcome back. Well, further recovery for the markets. In fact, the Nifty is just about lower by around 32 odd points. Maybe if this continues, we could probably even try to make a dash for the green at this point in time. And the advanced decline ratio is improved a tad bit. Let's see whether that's sustained. That should come up for you in terms of the graph. Currently around almost 1,400 stocks decline, advancing to around over 2,900 stocks declining. As you can see, there's a little bit of a narrowing which has taken place in the advanced decline ratio. But what's taking place on the F&O desk? We have Mangalam joining in to tell us more. Mangalam.
Well, the market is off lows, no two ways about it. The Nifty at 25,200. We have the Nifty Bank, which has recovered a tad as well. The Midcap Index too has recovered, though we're in the red, out of the woods, but perhaps not necessarily entirely out of danger. But for what it's worth, today's low and the panic low that we made on the market and the dramatic recovery after that gives us important reference points for the future as well. 24,920 will be an important point to track as we go forward. And for the Nifty Bank, today's low of 58,279 will be extremely crucial too. Important part of today's recovery is that, the Nifty is actually in this recovery after having breached the 25,114 mark, which is the 200-day moving average, has now reconquered that and formidably reconquered that. It's above almost 85 points above the 200-day moving average. And the Nifty Bank, the 50-day moving average of 59,269 is an important level as well. The Nifty Bank broke that, and now we are making an attempt towards conquering that once again as well. But the question is, with this recovery, should we build on further gains or not? Well, the answer to that will lie in what happens with the call writers at 25,000. With the market having recovered, the put writing has resumed at 25,000, which was an important support earlier, had breached that. There was a panic low. Thereafter, the market recovered. 25,000 put writers back in the fray. Premium sub 100 rupees, selling you around 24,900. Closer to today's low is an important support for the frontline index. But 25,000 call writers who were very active in today's trading session as well have now begun to lessen their positions. Has that caused this up move towards 25,200 or not is something we'll know as the day progresses. But the 25,200 call writers are still active. 75 lakh shares outstanding out there for a premium over 100, 200 rupees right now. So telling you between 25,350 to 25,400, there is still possibility of some supply likely in the market. Yes, there has been a dramatic recovery. Could we see it cross past that 25,350 to 25,400 mark is something that we will have to monitor very, very closely. The Nifty put call ratio as well, from extremely oversold levels of closer to 0.7 has now come back to around 0.8. Heavier put writing from here on would again take the market back into the supply zone, which may come at around that 25,400 to 25,500 level.
Okay, thank you so much for that, Mangalam. But let's also bring on board Pritesh Mehta, Executive Vice President at Yes Securities, joining us on the show to talk to us about the checks on the market and individual stocks. Pritesh, good afternoon. Dramatic recovery like we've seen in the market as well. After the dramatic fall, a good recovery. Today, what is the important level that we should watch out for in terms for the close for the Nifty, and what will it mean going forward? If we manage to close near those day high levels, 25,270, what will it mean?
Thanks for having me. Now, see, there are too many things happening around in the background. Market is reacting to plenty of noise coming from US. Japanese bond yields have rallied sharply last couple of months. But I'm more concerned with the internals of the market. Yes, yesterday we saw Nifty top 10 equal index going below the 200 moving average for the first time since the month of October. But this kind of move tends to result in a downside, but we have not seen that. Yes, it did mark a lower low, but thereafter we see a recovery. So I'm a bit optimistic from here on. Yes, risk reward ratio is quite favorable, and 24,900 is a level that we need to keep an eye on. 24,850, 24,900. There are cluster of supports coming in this zone, and I think it is more of a tactical move. We can say 25,500 is possible in the short term. But I think this is the range which is going to play out of 600 points, 24,900, 25,500. That is the short-term range we need to talk about right now. Nothing more than that.
Okay, a massive recovery. Nifty is now in the green, up 11 points. And we have seen a recovery of 320 points from the lows of the day. Eternal, Interglobe Aviation, a lot of these metal names are leading the recovery. So we'll have to just see whether we sustain in the green or not, because we've seen a very choppy session in the last couple of trading sessions. Pritesh, we do have some individual queries for stocks that have come by. Rupesh Singh is writing to us from New Delhi. He holds 100 shares of Coforge at 890 rupees a share. He wants to know the short-term view on the stock. What's your take here, considering whatever we are seeing in terms of volatility? He's sitting on decent profit of around 74,000 rupees.
I think, see, IT, if you look at IT as standalone index, was it has done well recently, but when you look on a relative basis, I think there is more space to on the upside for IT. So I think rather than focusing more on these particular stocks, there are better opportunities in the IT space. Something like Birlasoft, something like HCL Tech can do much better from rather than Coforge. So I think it's time to take some profits home.
Okay. All right. Thanks very much for joining in and taking us through all of that, all of those details, Pritesh, on the tech side. Well, we do have some positive, news coming in for Interglobe Aviation. That stock is down up around 1.8%, where the government is looking to remove the caps. Remember that this was following the severe disruptions with Indigo in December 2025. So now we are seeing that stock spike up on the back of that news, up around 2.3% at this point. But that's on Interglobe Aviation. We're going to take a short break. Up next, we're going to connect with the management of Senores Pharmaceuticals to discuss their Q3 performance. Stay tuned. Welcome back. Let's get talking to a couple of companies then. Senores Pharmaceuticals reported what was a strong set of numbers. The revenue jumped 64%. The profit was up around 86% on a year-on-year basis. Stock is up around 3% today. Remember, numbers came out during markets yesterday. We have Swapnil Shah, who's the promoter and the managing director at Senores Pharma, joining in now. Swapnil, hi. Thank you very much for taking the time out. Well, it seems as though you're probably going to exceed that guidance which you had given earlier of around 50% top line growth and 100% profit growth, margins at 24 to 26%. 9 months, you've already exceeded that. So just tell us, are you looking to revise it upwards, and what are you looking at in terms of an exit rate for FY26?
Well, we are most likely to outperform our guidance. How well? I think probably the next few days would have a better understanding. But so far, what the run rate looks like, I think we're most likely to outperform our guidance for FY26.
How much? And when you say for the next few days, what are you linking it to?
So we were starting the plant. So plant has already been acquired. So Senores Pharma that we acquired, I think we're looking to get some revenues out of Senores within this quarter. And as we anticipate the scale that we want in this quarter, if we achieve, then most likely I think there will be an outperformance on our guidance. So I think so far looks good. Let's see in another 15-20 days.
So Swapnil, you spoke about Senores Pharma acquisition, which is on track. You do have the third manufacturing facility line in the US, which should be operational in Q3 already. The fourth manufacturing capacity, which should be operational by FY26. When will it start showing in your P&L? What is the revenue at peak utilization?
So we've already started our third line in the US, as you already know. The fourth line is we kind of pushed it a little bit because we've acquired Senores, as you know, in about a month back. So I think a lot of capacities that we were utilizing in the US will be moving to Senores, which is likely relatively slightly low margin. So we have the advantage of low cost manufacturing from India, and this manufacturing is optional. It doesn't have to be made in the US, right? So we get both. So we get the capacity open in US for a high yield business, and we get Senores manufacturing done at a low manufacturing cost. So it's kind of win-win. So that's there. And coming to fourth and Senores, I think let's see how Senores scales up. We expect about 120 odd crores revenue coming out of Senores in next 12 to 15 months. And based on that, I think we'll decide how soon we want to kind of scale on the fourth manufacturing line from the US. So we are keeping those controls in check to see when we can execute that part.
Okay, so right now you all have not started that fourth line, which we are planning to open by the end of FY26, right?
We've kind of pushed it.
Pushed it, right.
2 months, yes, because our capacity came in.
Okay. What about, your emerging markets? That's done very well, right? In terms of margins, also sharp improvement there. Could you give us your growth expectations there from the emerging markets as well as the guidance that one could expect here?
So emerging market is going to be very strong. This quarter, it's emerging market, if you see historically also, second half of the year is always done better. And this quarter also, so quarter ending March 2026, is also going to be very strong from emerging markets. So as we've been stating over last few months that once we see those registration getting those commercialization, emerging market will continue to perform better. So what we have seen in last quarter will continue quarters forward. So I think from the guidance standpoint, we are most likely to cross 150 crore of revenue from emerging market this year, and that could be anywhere between 180 to 200 next year. So that's again a significant growth, and more so we got a 56 product registration approval last quarter. So subsequent to next couple of quarters, all the product registration approval that we got will get also commercialization. All in all, very strong emerging market growth also we anticipate in next few quarters.
Okay, that's interesting that you're expecting emerging markets to drive the growth. Just quickly before we let you go, Swapnil, how are you cashing in on this entire GLP-1 craze and phase which is taking place? There are so many companies which are tying up, marketing, distribution tie-ups as well. How are you participating?
So we are currently playing the GLP, sector through our emerging market business. So we have Ribulus, we have Ozempic, we have Wegovy, all 9 strengths as we speak today, all being developed and filed in a lot of emerging markets as we speak. In fact, we have more than 16 markets where we have already filed the semaglutide, all nine strengths as we speak, both orals and injectable. I feel that's going to be quite a bit business that it will generate. But are we going for a US regulated market play where all the large companies are kind of competing against each other to grab that share? The answer is no. I think we are good playing it in emerging market space that we are in and continue to show that growth and continue to have significant revenue coming out of those 20 odd markets that will eventually file semaglutide in.
Okay, take that point, Swapnil. Thank you so much for joining in. The street likes what you are saying. The stock is up 4% in an otherwise weak market. So that's the word coming in from Senores Pharma. They are expecting to cross their earlier guidance of 50% top line growth and more than 100% profit growth in FY26. Slip into a short break. We'll get you more on the markets and stock specific action on the other side. .350 recovery from the lows on the Nifty. We do have the mid-caps, which are underperforming. But yes, again, it's a massive recovery from the lows of the day. Eternal, Adani Ports, Interglobe Aviation, Reliance Industries are leading the recovery. So what happens in the next half of trading session? Keep tuning into CNBC TV18 for more action. We'll take your leave on this edition of Halftime Report.
It is a sharp recovery on Dalal Street with the Nifty and Sensex trading at the highs of the day now. The midcaps and the banks are also recovering from the lows of the day. The rupee, meanwhile, slumps to a record low as investors root for safety.
The promoter group of Ajanta Pharma strikes a deal to take control of Burger King franchisee restaurant brands Asia, and Cupid seals an investment deal in bazaar-style retail, even as Zydus Life and Sun Pharma are seen making significant overseas acquisitions.
SRF has slipped as pricing pressure from Chinese rivals continues to weigh on the performance. United Spirits has dipped as volumes have missed the mark. Shoppers Stop is hit by weak consumption, while Vikram Solar sees orders and revenues slip sequentially.
Gold and silver surge to record highs as investors flock to safe haven assets as geopolitical uncertainties cloud global economic outlook. The sell America dollar trade and yen's dip on Japan's fiscal worries add to the mix.
And the who's who of India's IT industry tells CNBC-TV18 that they are seeing a big opportunity in AI beyond making models in helping the industry adopt the technology. But some express concerns over the impact advances in technology can have on jobs. It's a dramatic reversal on Dalal Street. In just a couple of hours, the Nifty has recovered from panic lows to the day's high. Good afternoon. You're with us here on Business Lunch. We're coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Hormuz Patakia. With me, Arundhati Ramanan. Arundhati, good afternoon.
Good afternoon, Hormuz. And it's a very good afternoon for the markets indeed, especially versus this morning, right? Nifty and Sensex now in the green. The mid-caps and banks recovering marginally, but recovering quite a bit, but in the red still.
You're waiting to say that word.
Yeah, I was.
But yes, indeed, it's been that kind of a day, right? 24,919 was the low that the index made, and it's a 360-point recovery from the intraday low for the Nifty. So 50 points higher is where we currently stand. And Supreme Industries is one name that has come out with results just a few minutes ago. The company has maintained its FY26 volume growth guidance to be between 12 to 14%. That is one factor that you need to account for. The stock saw a bit of a spike and now has declined again from the highs. It has maintained its plastic pipes volume growth guidance to be between 15 to 17% and the overall volume growth guidance to be between 12 to 14%. So some choppy moves seen on the stock as of now. The numbers they have also so guidance has been maintained overall for Supreme Industries. We'll get you more details as the show goes by. But Arundhati, other than what has been the recovery on the index, one stock that has been leading that recovery has been Reliance. It was a very sharp recovery from the lows of the day. There is a bullish note coming in from CLSA as well earlier in the day. So Reliance is contributing. But what else is on your list today?
Hormuz, if you see those banking names, right, those big banking names which are holding up in yesterday's session are now leading those losses. You've got big private bank names like ICICI Bank, Axis Bank and HDFC Bank, all of them in the red. We've got Kotak Mahindra Bank, which is in the green, but ICICI Bank is the top loser on the Nifty today. That metal pack has managed to inch its way into the green. We've got Hindustan Copper, Hind Zinc and JSW Steel, all of them managing to gain between 1 and 3%. But in stock-specific action, as Hormuz pointed out, Reliance is leading the gains on the Nifty and has recovered over 2% from lows. And meanwhile, Kalyan Jewellers is the top mid-cap loser, seeing cuts of over 11% and has fallen for 8 straight sessions, while SRF is under pressure on weak earnings. And the fact that it is likely to miss its chemical business growth outlook also weighed on the stock.
And that has been the story of the morning. Kalyan Jewellers now down for the 8th day running. SRF too seeing losses of around 5%. So of course, make no mistake, there are still plenty of stocks that are bleeding in the broader markets. And Supreme Industries has now recovered from the lows of the day, now just 0.5% lower on the stock. But the other major story today has been the fall in the currency. It has touched a new low, 91.50. Is where the currency fell to, now 91.56. So now even further as we speak, and that is on sustained foreign selling of Indian equities and poor sentiment across the markets. And despite the markets recovering from the lows, the same can't be said for the rupee, even as the RBI is said to be intermittently supplying dollars according to dealers. Lata is here with more on this. Lata, good afternoon.
Well, it has been a bad last 24-48 hours for all asset classes. So rupee, which as an asset class was already under pressure felt the worst. So again, nothing new about the reason why the rupee is falling. There has been incessant FPI selling of Indian equities, buying dollars and repatriating it, and much the same is continuing to happen. And it kind of compounds because when you're expecting, when you see those FPI sell numbers, importers come and book dollars for future purchases, exporters refuse to sell the dollars they've earned, all of this exacerbating the fall. I just want to add another technical factor. The month ago, contracts entered, sell-buy contracts entered into by the Reserve Bank in the NDF market matures in the earlier part of the day. So today's month ago dollars, contracts mature. Many banks find themselves short at that time. It matures around the 1 p.m. period. And therefore, at that time, there is a heightened buying of dollars. That also adds to the pain. So the expectation is that once that 1 p.m. Rush of buying dollars is over, the dollar fall, the rupee fall or the dollar rise may kind of peter out. And now the stock market also is showing signs of stability. So possible that the worst of the fall is behind us for the day. We live in that hope. And the additional factor, of course, is that falling rupee actually corrects distortions, helps exporters, stops imports from coming in, or rather makes imports expensive, and therefore domestic industry does better. So falling rupee has a lot of advantages for the currency. The problem is that when it is a concerted fall and there is an expectation of further fall, even investors who want to bring money will wait. So a stability will help, and that's what one is waiting for. One hopes the stock market is giving us good tidings.
All right, Lata, many thanks for those details. The rupee hitting a fresh low, and hopefully the worst is behind for the rupee for the day. But moving on, 2026 has seen the worst start for the market in the last 10 years. Before we go to Sudarshan for the market data, here's some opinion from market veteran Sunil Singhania on the current state of the Indian market.
A lot of parameters are starting to show signs of, I would say scare at the peak. The number of new lows which we hit yesterday was almost 750, 800. It's a good indication. I think 52-week lows after a not so great year, particularly for broader markets, point that a lot of investors are giving up and just throwing up stocks. On the other hand, on the global side, yes, I think this Trump mania has been reaching peak. But now I would say the good thing is that almost all countries have started resisting it. We have a budget coming in. The macro parameters are pretty steady and healthy. Balance sheets of corporates are pretty steady and healthy. Obviously, the external environment is such that growth is right now on the corporate profit front stuck at 9-10%. But looking at the scare and looking at the kind of views and news flow coming in, I would stick my neck out and say that, it's time now to start investing. In fact, last 1 week, we have been quite aggressive in investing. And it's not about large cap, mid cap or small cap. It is about stocks where there is visible profit growth and valuations are not out of whack.
Sudarshan is joining us now on the markets, which have had a weak start to 2026. Sudarshan, tell us more.
So it's a good recovery we are seeing in the market. Nifty, led by Reliance Industries from the intraday low, has gained almost 200 points. But nevertheless, if you look at the 13 trading sessions data, it's the weakest start for our Indian equities that we have seen in the last 10 years, or say since 2016. And it's the third straight year that we are seeing the negative returns in first 13 trading sessions, in which Nifty is now down almost 4%. And this loss has resulted in the market cap loss for BSE listed companies, and so far we have erased market cap of more than rupees 25 lakh crore. Now take a look at some of the indices which have seen a major fall. So frontline indices, Nifty is down 4%, same for Sensex, down 4.4%. Nifty Bank has relatively outperformed, it has slipped 1.6%. Major pain has been seen in the broader markets. Midcap index down 6%, small cap index has fallen 7%. What about the top Nifty losers? So if you take a look at all the 50 stocks, 33 stocks have given negative returns so far this month, and of which 6 stocks have seen a fall in the range of 10 to 19%, and 17 stocks are down in the range of 4 to 9%. Top Nifty losers, ITC down 19%, Trent down 13%, Reliance down 12%, Jio Finance down 10%, Adani Enterprises down 10%. Now, this was about January 2026. If you take a look at the data of last 1 year, Indian market is the biggest underperformer. In the dollar terms, it has given the returns, positive returns of just 3%. S&P 500 up 12%, Hang Seng up 31%, DAX 32%, and same for Nikkei. What about going forward? So over the next few days, on one thing that will matter the most is the commentary that we get from one man. And that's only one person, Donald J. Trump.
Only Donald Trump is what is grabbing headlines right now, globally, locally, Davos, everywhere. Sudarshan, thank you for that update there. Take a short break. More news and updates on the other side. Stay tuned.
Coverage continues here from Davos 2026. We are bringing you all the live action. As I told you, today is D-Day. It's Donald Trump Day. But what we do now know is that because there was a technical snag on Air Force One, President Trump had to go back and board another aircraft, the backup aircraft. And so there is going to be a delay in his arrival here in Davos, perhaps by about 3 hours or so. That's as per Scott Bessent. But of course, we'll be tracking all the action. Well, a group that is in many ways linked to what President Trump does or does not do, what he says or he doesn't say, is the Wellspun Group. And joining me today are BK Goenka and Dipali Goenka. Thank you very much. I understand this is the very first time that the two of you are doing an interview together.
Absolutely.
One of the many firsts here on CNBC-TV18. But let's start with what the expectation is from President Trump and the new world order that he's trying to set.
No, I think there is a lot of concern and also inside, everybody's mind, the issues that what is going to be the next. And I think the whole world order, as you said, is going to be different, looks different. And I think this is going to be a new norm and new world. And I think the whole thing is being rewired, if I can say that. And the situation, I think what we have to see is that how the whole part of Europe is going to pan out, going to react on this particular reaction on the Greenland.
Greenland threat, yes. You know, we don't know and we can't preempt what he will say or do, but we should talk about what is in your control, and that is business. So what is business looking like at this point in time, and especially in a world of tariffs, but also in a world where oil and drill baby drill is also the new norm? What does it mean for your business specifically?
So I think for us, different situation in different businesses. I mean, Deepali will talk about textile, but when I talk about oil and gas pipeline, I think in US we are looking very, very good. And thing what is right now is that overall the demand from the AI sector, particularly data center, the power demand, even if that happens 20%, what is being discussed, I think there is a absolutely good visibility in US for next 5 years from the angle of the requirement of the energy, whether it is coming from the gas or it is coming through the renewable, it is going to come through the ultimately from nuclear, which is long drawn. But I think next 5 year going to be 80% coming through the oil and gas.
So what could that potentially mean in terms of revenue for you?
I mean, we are already in expansion phase and we are almost tripling our capacity in US, and accordingly I think
investment
of almost $500 million overall in US and Saudi. And within US we are doing around $400 million. So that's going to triple our top line, as well as hopefully I think we'll see a better bottom
line as well. But you know, one of the other developments that's taken place is of course what's happened in Venezuela, and President Trump making it absolutely clear that US oil companies are going to go all in. Of course, oil companies so far are a bit more apprehensive on what all of this is going to mean in terms of putting money on the ground. How do you see this development and what it could potentially mean?
I think immediately, if you see nothing going to happen there. I mean, it's in anything what is to be, you have to develop the oil and gas area, it takes 3 to 5 years. So I think we have still time to go. But yes, a lot of buzz there, but on the ground really things are not yet settled.
Things are not yet settled. Okay, well, we will talk.
A conversation there with the management of the Wellspun Group, and continuing our coverage there from the sidelines of the World Economic Forum in Davos all through the day. By the way, just before we take that break, look at the currency again. 91.67 is where it stands now, extending its losses even as the markets have staged a bit of a recovery from the lows of the day. But since then, it's been a one-way downward move for the currency against the US dollar. 91.67, and on cue, the recovery in the market is also getting sold into. So from almost touching levels of 25,300, we are back down to levels of 25,200, still significantly off the lows of the day, Arundhati.
Absolutely. And speaking of Davos, right, the most anticipated presence at this year's World Economic Forum is US President Donald Trump, but we'll get more details on that in just a bit. It's time for us to head into a short break. More news and updates on the other side. Welcome back. You're still with us on Business Lunch. The most anticipated presence at this year's World Economic Forum is US President Donald Trump, who is en route Davos after the Air Force One plane returned to the US due to a minor electrical issue. According to a White House official, the US president has now chartered a smaller 757. The president was scheduled to speak at the Davos summit tonight at 7 p.m. Indian time. However, US Secretary of State Scott Bessent has now confirmed that his address has been delayed by 3 hours. Amid the rising rhetoric on Greenland, Trump also said he has a lot of meetings scheduled in Davos to discuss the territory and suggested he could use tools beyond tariffs to get control of the Arctic island.
And amidst all of these Trump tariff threats, reports say that the European Union is likely to suspend the previously agreed US trade deal. CNBC's Dan Murphy with more details.
The European Parliament is reportedly set to suspend the approval of a trade deal negotiated with the US back in July. Multiple reports now suggest the suspension will be announced in Strasbourg today. As part of the agreement, US tariffs on most European goods were set at 15%. That's half the initial level, while the EU agreed to invest in the US and make changes that were expected to boost US exports. Speaking to our US colleagues here in Davos, the US Commerce Secretary Howard Lutnick said he did not expect the US-EU trade deal to change.
I don't see it changing. I don't see it changing. And if it did change, it wouldn't change in the benefit of Europe. That means they want cars the way they have it. They want pharmaceuticals the way they have it. It's been very successful. I mean, think about it. Their stock market's up strong double digits. It is. Right? So why would they mess with that? They really need to understand that they should keep the pressure and temperature low. This is just, let's talk to President Trump and let's talk together.
Meanwhile, the European leaders addressing these rising tensions at the World Economic Forum in Davos and warned of a changing world order. Listen to what they had to say.
Plunging us into a downward spiral would only aid the very adversaries we are both so committed to keeping out of the strategic landscape. So our response will be unflinching, united, and proportional.
Without collective governance, cooperation gives way to relentless competition. Competition from the United States of America through trade agreements that undermine our export interests, demand maximum concessions, and openly aim to weaken and subordinate Europe, combined with an endless accumulation of new tariffs that are fundamentally unacceptable, even more so when they are used as leverage against territorial sovereignty.
An American hegemony in particular helped provide public goods, open sea lanes, a stable financial system, collective security, and support for frameworks for resolving disputes. So we placed the sign in the window. We participated in the rituals, and we largely avoided calling out the gaps between rhetoric and reality. This bargain no longer works. Let me be direct. We are in the midst of a rupture, not a transition.
Blackstone's Stephen Schwarzman also spoke to Shireen Bhan on his top sectors to watch in India in 2026. Take a look.
We'll continue adding companies at an accelerated rate because we'll have the monies to do that. In real estate, there's always exciting things to do as data centers are developing. There have been a series of announcements, as you know, of what people hope to do. We're one of those hope to do people also. We've already been building some. Whenever you operate with a country that's on the right track, there are always new opportunities that you didn't see. We did something in the money management business there. That's done really well. Something in the housing business, that continues to do well. So, India has a very stable political structure now, and it's doing the right types of things. So we're finding an increasing number of things to do.
And with that, we take a leave on this edition of Business Lunch from Arundhati and me. Thank you for watching. The Nifty, well, it was around 90 points off the highs of the day. It's come down to that now. The rupee, though, continues to remain at record lows. Midcap radar on the other side.
Good afternoon. Welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Vivek Iyer. What a massive recovery we saw around 12:30. A bit of it is sold into, but I don't think there are much complaints from the bulls as well. We are above that 25,200 mark. After slipping below that mark, we are closer to 24,919. So it's a massive recovery from there. But Rupee continues to extend its losses.
That's right. Good afternoon, Sonal. So many cues that we're tracking overnight, important events, important developments from Davos, as well as the kind of volatility that we're seeing in the markets. A lot of cues, a lot of earnings, something that we're digesting. A lot lined up on the show. Very important corporate conversations as well. So let's start off with the top headlines. Market recovers sharply from lows led by heavyweight Reliance Industries, but still remains volatile. Midcap index and banks continue to remain in the red, but sharply off intraday lows.
IndiaMart into May share surge 5% today after the company's Q3 profit surges 56% while revenue jumps over 13%. The management tells CNBC-TV18 that they expect respite in silver segment churn next year.
SRF slips over 6% today after the management in its Q3 conference call says that persistent pricing pressure from Chinese competitors has weighed on the performance and that they remain cautiously optimistic on the demand.
Kalyan Jewellers shares tanked nearly 15% in trade on heavy volumes. Motilal Oswal Midcap Fund holds nearly 9% stake in the company, while the promoter pledge remains nearly 25% as of December 2025.
Vikram Solar declines over 7% following its Q3 results. The company's order book remains muted but also declined sequentially. We will be speaking to the management shortly. Stay tuned for that.
Okay, all right. Those are the top headlines that we are tracking. We do have some managements lined up on the show as well. But mid-caps, they continue to be the talking point. This is our special segment, Mid-Cap Movers. We have Gaurav to take us through the mid-caps that are moving around in trade. Gaurav.
Well, it is actually a volatile market today. And if you look at some of the movers, first let's talk about some of the gainers today. First is Rostel Taxis. If you look at this stock, the volumes are very strong. And at the same time, if you look at the move, it is up more than 10%. MRPL is yet another stock with strong volumes and a strong move here. Credit Access Grameen. Now, this stock is specifically in focus because since morning, we have seen this stock moving up. And the reason being that strong asset quality and at the same time, management is also very firm about the growth and asset quality outlook going ahead. Supreme Petrochem and Senores Pharma. If you look at these stocks as well, we are seeing strong volumes. And in fact, let's not forget that Senores Pharma just a few minutes ago came on CNBC and said that they can actually exceed their FY26 guidance. We are seeing some rise in this stock. Other than that, if you look at the losing side, we are seeing Kalyan Jewellers, who has not only been a top loser, one of the top losers with strong volumes, it also hit its 52-week low level. Apart from that, we saw Shoppers Stops, Aarti Surfactants and SRF. All of these stocks are seeing some kind of pressure with high volumes and some kind of pressure on the lower side for continuous 2 days in a row. Apart from that, let's also talk about some of the mid-cap stocks who are actually or who were at their 52 weeks low. And we've got Tata Chemical, AB, Aditya Birla Fashion and Retail, Balrampur Chini, Godrej Properties. All of these stocks actually hit its 52-week low. In fact, let's also not forget Godrej Properties was there yesterday as well, reaching its 52-week low. So it has reached its new 52-week low today. Other than that, we are seeing some of the stocks which are actually reacting to their results. First is Tata Communication, Thangamil Jewelry. These companies will come up with their results today. If you look at Anand Raj as well, we are seeing some kind of gain. And lastly, let's not forget about Bajaj Consumers. Now, the company will come up with the result, but as of now, we are seeing some pressure. Stock down more than 4% today.
Well, thank you so much, Gaurav, for joining us and giving us a comprehensive list of all of the mid-caps that are moving around in the session today. Well, moving on, an important conversation like we promised. Supreme Industries reported a mixed set of Q3 results just a couple of minutes ago, with the profit and margin falling during the quarter. But the management has managed to maintain its FY26 volume guidance. To discuss the numbers and the outlook going forward, we have with us MP Taparia, the Managing Director at Supreme Industries. Good afternoon, sir. Thank you so much once again for joining us. Well, what has given you the confidence to maintain the guidance as far as FY26 is concerned, and any early signs of guidance that you could provide for FY27, sir?
Good afternoon. Thank you very much. We are quite seeing good demand prospect in the last quarter, and that's why we are able to maintain that volume growth will be between 12 to 14%, and piping demand will grow between 15 to 17%.
Okay, take that point. So you also indicated that EBITDA margins for FY26 could be between 14.5% to 15%. At the 9-month mark, your margins are at 13.7%. You're confident there as well that you'll achieve that guidance? Also asking because we spoke about that reversal in pricing in PVC. Is it the reason why you are confident?
In the 9 months, there was too much erosion in all the polymer prices. So now we have reduced the margin guidance. We anticipate it is going to be between 13.5 to 14% this year.
Okay, so EBITDA margin guidance has been revised onwards to 13.5 to 14% from the earlier 14.5 to 15%. Is that correct, sir?
Yeah.
Right. So the other point that we want to understand from you is that, as far as global markets are concerned, we understand that there has been an increase taken by the Chinese authority as far as VAT is concerned. Now, for the Indian market, does that mean you will enjoy higher market share, and can there be a recovery on prices due to this development?
We are quite happy that we will be growing by 15 to 17% in plastic piping segment. Our systems are all well accepted, and we anticipate, as we have grown 16% by volume in plastic pipe system in third quarter, we are confident that we will be able to achieve the volume guidance what we have given now.
Sir, wanted to understand where pricing is currently, and as my colleague also just mentioned, what's happening in China, just trying to understand with the ADD that was going to be imposed, the pricing that we are seeing in the domestic markets, are you going to see recovery in PVC pricing? Has it bottomed out? What kind of growth did you see in quarter 3?
No, we do not see any possibility of imposition of ADD now. That is not possible. But definitely the Chinese price also started inching up. Chinese government announced some withdrawal of incentive on export of several items, in which PVC was also there, which is going to be effective from 1st April of this year. And that's why the Chinese exporters have increased their price to some extent. In Indian market also, the PVC prices have gone up, and Rupee also going down, and we are very much dependent on import. So we believe that the worst is behind us.
So we understand that in the last 2 months, there have been a few price hikes that have been taken by the domestic PVC players. So going forward, how do you see pricing pan out? Where are they currently?
No, the prices were only going down continuously up to December. Now only from start of this year, 2026 January, the prices started inching up slowly but surely.
Okay, and this trend is expected to continue, Mr. Tapadia, the increase in prices from here on?
Sorry?
Do you think prices will continue to see an upward movement the way that you've seen it in January?
Now, we have seen that many producers in the world have curtailed their production, and some of them have closed also their operation completely. With the making PVC has become very unaffordable. So we believe that when such thing happens, that there is no chance of prices to go down, and we are seeing the crude price are also maintaining above $60. So we are very firm, and now in India the season is going to be full swing. The demand coming from agriculture, housing, infrastructure are very robust going forward. And the consumption demand will be more in this quarter and second quarter of this year. So we do not believe that there is any chance of erosion in PVC price now going forward.
Okay. Take that point. If you can quickly tell us, sir, what is the kind of capex you have planned now that you're talking about strong demand? You do have a lot of it already in place. Any fresh capex you'll be announcing? Will it all be funded again through internal accruals?
Anyway, we have got enough capacity in place. This year we have invested around 1,200 crore. 1,030 crore assets are already up and running. So we have got adequate capacity in other segments where we are operating this year.
Okay, Mr. Tapadia, once again, thank you so much for joining us, and we wish you all the best for a strong Q4 as well as a good FY27. Well, we'll now slip into a short break. We'll get chatting with the management of Vikram Solar on the other side.
Welcome back. You're still tuned into Midcap Radar. Let's now focus on Vikram Solar. The company reported a strong set of earnings in its December quarter, with profits seeing a multifold jump while margins expanded significantly. This is on a YOY basis. We're now joined by Gyanesh Chaudhary, the CMD at the company, to break down the numbers. Most importantly, talk about the outlook going forward. Mr. Chaudhary, good afternoon. Thank you so much for joining in. While YOY the numbers look really strong, if your revenues are up 7.8%, your EBITDA is up 141%, it's a sequential decline. Profits are down 24%, EBITDA is down 12.5% on a quarter-on-quarter basis. If you can explain what's happening there, because we've been talking about overcapacity in the sector. Is that impacting realizations and pricing? What is the current pricing trend for solar modules?
Thank you so much for having me. I think we're looking at a quarter which is in isolation, but as Vikram Solar, our 9 months EBITDA stands strong at a 20+%. And that comes from resilient and strong order book and delivery quarter on quarter. So as far as the between the quarters, the so-called dip in EBITDA is concerned, it's more to do with working in a resilient market and making sure that we are able to meet the demands going forward. So we have no doubt that we'll be achieving our forecast at the year or the end.
Okay, Ganesh, first up, thank you once again for joining us. I believe you're seeing it for the first time post the IPO listing as well. See, the first thing what we want to understand from you is by now it's well known that there's quite a lot of competition in the market, and investors have been bracing for a dip as far as spreads are concerned. There's been a slight moderation of spreads on a QOQ basis. Going forward, can these levels sustain, or do you expect realization and spreads to moderate further?
Thank you, Vivek. It's great to be back. As far as the industry is concerned, I think the resilience comes from the fact that there is so much of demand that is still waiting to be had. We have a strong order book, as I said, but also the macroeconomic factors are not slowing down. We see that there are a lot of government contracts and tenders getting awarded. The DCR mandate is coming on stream as we speak. So all of this combined leads to a strong, fiscal next year and also Q4. Basis whatever is happening from the China quarters, what we see is that in the short term we saw supply chain volatility because of capacities in China getting constrained and all of that. But this phenomenon will be well taken care of as soon as Indian capacities come, and also going forward we are seeing prices hardening in solar modules. So this is more a story of resilience, as I said, than actual dip.
We do get that point because there has been a lot of focus on renewables. But as Vivek also pointed out, while we are seeing a lot of demand come by, the supply has also increased. And that's why maybe the near term looks on the downside because of lower realizations. Is this a trend that will be short term, or do you think it will have a larger term impact? Because while we are seeing a lot of enthusiasm around the space, at the end of the day, if it doesn't flow to the bottom line, that would impact returns for shareholders. So trying to understand the long term picture here.
Exactly. Thank you so much. The way I see it, this oversupply is more of a phenomenon that is being built out basis the absolute numbers that are coming out. But when we dissect it basis technology and capacity utilization, you will see that the companies which are doing well are the ones that are achieving higher capacity utilization, sweating the asset more, as well as working on technology which is far superior than the others. While we see that the market is now split between mono PERC technology and TOPCon N-type technology, Vikram has taken a conscious call and moved completely into N-type TOPCon technology because it is better yielding. The LCOEs are better for our customers, and therefore this will drive the wave of newer purchasing decision making. So I think when you talk about capacity, we must also take cognizance of technology along with it.
Okay, Ganesh, the other question is We want to understand how the rise in price as far as silver is concerned is impacting. We believe that will have an impact as far as EBITDA margins are concerned. Can you quantify that impact for us? And how does, do you have enough inventory so that going forward you could probably manage this a little better? And the second question is, so far you've been largely domestic focused, but, significant portion now of your order book is on the export. So what kind of realizations and margins can we expect there?
So we've seen a great phenomenal change in our overall cost stack, and this is true for all large manufacturers like us. We've seen that our competitiveness with China has greatly improved, which was earlier impacted because of capacity utilization or availability of large equipment manufacturing infrastructure. So with all of that, now with us, we feel that we are ready for expansion beyond we just call US, but now we talk about Europe, Middle East, and other regions because the competitiveness has increased. Further, when China comes up with their announcement that they're going to take away VAT on solar panels, therefore the differential gain that the Chinese manufacturers had is going to be gone very soon. That gives Indian manufacturers like us a larger play to play in the international market. As far as silver is concerned, yes, it's a concern, but there are multiple technologies at play which are currently under various stages of commercialization. It will help in reducing the silver consumption, but also one very important factor we cannot forget is that this industry works on this sort of volatility. In the last 20 years, we've seen many such cycles. But as far as silver is concerned, it's a part of cell manufacturing or cell as a raw material, and it is usually a pass-through. So when there is significant change in buy-side pricing, it usually is a pass-through to the ultimate IPP or the developer.
Understood that. Well, a couple of targets as far as capacity expansion is concerned. At the end of FY27, where will you stand? We understand that you've moderated your module capacity addition guidance by close to 2 gigawatt. Is that a near-term phenomenon or going forward, that will come back on stream soon?
Great question, Vivek. We are a technology company and, we thrive on latest technology in solar manufacturing. And for us, absolute capacity is just a nameplate. So when we say 17.5 by FY27, we would still be able to come to that point with a lot of upgrades in our existing lines going forward while investing in new lines. So at the end of this year, we will be at 15.5 gigawatt. And with various improvements, process improvement, technology upgrades, we will end up at 17.5 irrespective of any significant capex even.
Okay, take that point. Thank you so much for joining in today with your thoughts and the outlook on the business going forward. That's the word coming in from Vikram Solar. The stock is low by 8% as we speak. Strong YY growth, but sequentially, there has been a dip in margins. We'll slip into a short break. When we come back, we'll get you more on the markets and stock-specific action. Stay tuned for that. Welcome back. Well, from the broader markets, SRF is one stock which is at the day's low. The numbers were reported yesterday, but the commentary is something which is spooking the markets. They did indicate that the pressure from Chinese competitors across some of the core product categories is something which is impacting specialty chemicals margins, even in their nylon cord fiber or their technical textiles. That is one issue, along with US tariffs, which is leading to some pressure. So that is one stock that should be on your radar. But other than that, we'll take your leave on this edition of Midcap Radar. Stay tuned. Closing bell when we return.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Hang is managing to hold on to a very flat start. Nothing much of an up or down that we're seeing there.
I mean, the sell-off on Wall Street is a bit of a catch-up to the turmoil that we've seen, especially in European indices, etc. Nifty is now flattish. We'll see if there's another wave of selling which hits, or is there any interest on the other side.
I think the key marker to watch for is the global bond yields. Now, yesterday we had the Japanese bond market blow up.
I think 26 has started off with a lot of news flow, a lot of concerns.
Post 12:30, you see some kind of recovery. For the time being, there's a bright red all across the screen.
Quite clearly a seminal $500 million moving out every single day practically after the market started in right earnest in 2026.
A ready 500 store access is what Cupid gets through this deal. Because of the global events are the best time to invest in the markets.
What a massive recovery we saw around 12:30. A bit of it is sold into, but I don't think there are much complaints from.
Well, that was the day so far. Hello and welcome to Closing Bell. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Rima. In a short while, Prashant will join in as well. But it's that sort of a day for the markets. We were down close to 250 points odd. We've recovered a little bit, but still very, very skittish, Rima. And I think the story of the day is really the Indian rupee. That's not pulled back a good deal. Until we see weakness out there, that's going to be a bit of a problem, because those hopes of FI flows coming back, they go out of the window if you continuously see this rupee depreciation. From the day's low, it's pulled back a little bit, yes, I know. But otherwise, even after this pullback, you have 3 stocks that are declining for 1 stock that's advancing. So you'll have to say the pullback that we saw today was from extremely oversold levels. I think on a closing basis today, if the bulls can at least conquer the 200 DMA on a closing basis, they'll feel a little bit better, but very, very skittish.
Indeed, and even the Nifty bank is under pressure, right? So while the frontline indices have managed a recovery, the Sensex nearly 1,000 points from the session low, the Nifty bank is still down close to about 630 points. The advanced decline ratio is still in favor of the losing side. At peak pessimism closer to 11 o'clock, we had an advanced decline ratio closer to 1:7. Now it stands at 2:5. So, but as you can see, once again, in the last 30 minutes, the gap between the two is widening. We've still got 1.5 hours of trade to go. It's been a roller coaster ride. The first half of the trading session, a lot of weakness. But in the second half, there has been a recovery. How durable is it? How much can it extend itself? Sandeep Tandon, founder and CIO at Quant Mutual Fund, is now joining in. Perhaps just make sense of the kind of moves that we've seen in the market since the start of the year. Sandeep, this is not quite the 2026 beginning that we were hoping for after the underperformance of last year. 3.5-4% lower now in a span of 14 trading sessions, and on the Midcap index closer to 4.5%. And the rupee that continues to weaken, 6 consecutive sessions of losses. How are you all at Quant assessing the weakness?
So if you recollect in your own program, the market forum, I talked about that after a difficult 2025, we are entering into fragile 2026. And we talked about this year we'll remember as a PE contraction phase globally. Okay, this is what our macro analytics was endorsing, and it is moving in that direction where we are seeing PE contraction and we have seen a sharp sell-off happening in the expensive stock. So the way I look at it, the market is a phase which we have to live with that. Okay, we have seen very easy phase for last many years. If we are in a challenging phase, you have to rebalance and reposition your portfolio in such a manner that you can face these challenges and still generate alpha out of it. But we have to also understand in the context which we are in right now. Okay, obviously, logically, we are always bullish on the long-term perspective, but from a medium-term and near-term perspective, these are the challenges which we are facing. And it's not about India-centric. The challenges is more on the geopolitical front. There's a battle between US and China, and other countries are a part of that collateral damage which is happening, and it's a dollar supremacy. So it's a much larger thesis which we have to, if I have to sit down and discuss the macro, this is the way it's playing out. Now we have to play it very intelligently. Okay, when I say intelligently, let's understand, if we talk about that, we are talking about a PE contraction phase, and why we are saying PE contraction phase. Let's understand that first. The most important thing is that the risk appetite, particularly in the global equities and developed market, has started shrinking. Liquidity cycle has also peaked out globally. So we are in a phenomena where we can expect the peak space can continue. Now, let's say how to take advantage of this situation. Obviously, the first thing is that we think that growth stocks logically will underperform and value will outperform. And within value, you have to identify the opportunity. So the way we have constructed our portfolio in today's context, the first priority is liquidity. So our portfolios are very liquid. B, safety is the second priority, and third priority is the return. That's the way we have defined the broader thesis. And within that, we are trying to identify all the stocks, let's say for what has not performed in last 1, 2, or 3 years, which are attractive, reasonably valuations are there. They're relatively underowned. I'm not saying you will find some completely underowned stocks right now, relatively underowned. And some of the stocks are now reaching with a frustration in the market and relatively hated zone. So these are the names which we want to capitalize, and given the trend which we are seeing globally, so I will be playing a very stock specific, and we're also playing from a short term and medium term perspective rather than saying everything is long term.
So liquidity, safety, and then returns, right? That's the thesis you're going with, right, Sandeep?
Yes.
Okay, just one quick word then. The mid caps, do you think they're going through a healthy shakeout? Or do you think there's a structural derating taking place on the mid and the small cap space?
So Nigel, let's understand, last year or last few years, mid caps being the way AMFI defines mid cap is only 150 stock technically. Okay. So when you have only 150 stocks and everybody is chasing them, and the extraordinary money has come to the mid and small portfolio schemes in the mutual fund also, and global also people were chasing. So obviously the valuation of the mid cap space particularly has been very, very stretched. Okay. And if that is the case, and we are talking about the contraction phase, then I think the derating in some of these stocks, which has become very expensive, and we have started accepting that this is the expensive names and will remain expensive from a longer term perspective. I think those are the names where we see vulnerability is very high. After, let's say, 40-50% correction, some of the names, somebody comes and tell me I will be buying opportunity, like the EMS space or something like that. But I think it's the beginning of that trend. Okay. So I don't see that this pain is over in the overvalued stocks. Now this challenge comes or the opportunity comes. How you use this opportunity? See, when market falls, everything falls. Okay. But when market recovers, the good stock will bounce back first. So we have to understand, the question comes how you define good. Every cycle is slightly different from the previous one. So this cycle, the way we looking at the market is all about how to capture these opportunity when, let's say today, yesterday, or last 3-4 days, we have seen good amount of panic happening, and market obviously has broken certain technical levels, which a lot of people track from a behavior perspective. And obviously when these levels start breaking, people started believing the structure breakdown. And there is no debate on that, but the structure of the market has become very weak. Now, we all understand, are we there for just 6 months or 2 months from a portfolio when we invest from a longer term perspective? And we always talk about investors and asset class. Equity in asset class is long term and investors are long term. So we have to look at from a longer term perspective. I think it's a brilliant opportunity if you can switch your portfolio, rebalance your portfolio, and without any hesitation. You should not feel, oh, I am booking a loss now. I have seen this price at the peak. Now it's down 30%, 40% from the peak. And this is the where psychological games comes to picture. People are not able to book profit. What we have to look at, even 30% correction, whether this stock has potential to bounce back or will give me that desired alpha. If you are not seeing, given the environment which I'm talking about, I will like to rotate. This is what exactly we do at Quant, and we do it ruthlessly in that sense, because the moment you bring your emotional attachment, association, then the problems start. If you are convinced about the cash flow, if you're convinced about the valuation, convinced about this is opportunity from long term, then you have to switch to these names and get out from the all most expensive and over admired territory stocks.
Sandeep, we'll chew on that thought, but request you to just hold on for a moment, because we have Hormis and Sonal, both of us, joining in to just put light perspective on the broader market pain that we've seen and what investors should be watching very closely. Harmas, you go first.
Well, when you usually see such kind of moves across the year, but we are just first 2 weeks into 2026 and we are already witnessing the extremes of the market. You take a look at the Nifty, down 4% as of now. The mid-cap index is down 5%. The small-cap index is down 6.5%. Just to jog your memory back, the small-cap index was down 7% in all of 2025. It's down 6.5% in just the first 2 weeks of the year. Now, to take a look at stocks that are down more than 10%, 4 of them on the Nifty, 25 of them on the mid-cap 100 and 33 of them on the small-cap 100. So, almost a quarter of the mid-cap index and a third of the small-cap index has stocks trading 10% or more lower. Now, you break it down into a slightly broader gamut of stocks on the Nifty 500. Here too, 430 stocks are trading with negative returns on a year-to-date basis. Now, on a returns front, if you take a look at the number of stocks that are trading with losses of more than 20%, already there are 11 such names. Almost 300 stocks are trading with losses of anywhere between 5% to 20%. That's the kind of fall that you're witnessing in the broader markets right now. It's not as if everything is down. There are some outperformers as well. You take a look at least 7 names, predominantly mostly metal names that are up at least 10% or more so far. Now you take a look at the underperformers. Tejas Networks was the worst performing stock last year. It's continuing that in this year as well. Cohance, Godfrey Phillips, Newgen, Elecon, all of them down anywhere between 23 to 25% so far this year. Now the outperformers. We spoke about Jindal SAW over the last couple of trading sessions. Metal names, Nalco, Hindustan Zinc, PSU banks have done well as Union Bank, and Emcure Pharma too finds the name in this list of outperformers. Now going on to the BSE 500, and here too 425 stocks trading with negative returns so far in 2026. Breaking it down, 14 such names are trading with losses of 20% or more, and even at least 300 names in this index as well are down anywhere between 5% to 20%, and there are 8 stocks that are trading with gains of more than 10% as well. Here the list of underperformers is even more stark. Allied Blenders is down 30%. CE Infosystems or MapMyIndia, one of the most touted IPOs, is down 25 already. HBL Engineering, Signature Global, the entire real estate space has been smashed so far this year, and Sapphire Foods as well, after the merger announcement, has only extended its losses if not more. So that's the kind of pain you're seeing in the broader markets. At the index level too, there is pain, but when you break it down into specific stocks, that pain grows even louder.
Okay, all right. Thanks a lot, Harmas, for that. All the complete list of stocks. But let's also focus on the performance of mutual funds in 2026. Sonal is here to decode the pain in the broader markets and how it's impacting the mutual funds. Sonal, I want to listen to this.
Thank you so much for that. But at the outset, I just want to say that before investing in any mutual fund, the YTD return or one-year return should not be looked at. But yes, since we're talking about this massive mid and small cap fall, that is seeing an impact on mid caps as well. So in the small cap segment, we have LIC mutual fund, which has seen an 8% decline year to date. It's a 16% decline in last 1 year itself. It's followed by Motilal Oswal small cap fund. There's Quant small cap fund, JM small cap fund, which is down around 12.5%. There's Quantum small cap fund, which has fallen lesser. It's down 3% year to date, and Sundaram small cap fund falls in the same category. It's down 4% versus other funds which have seen a bigger fall. And Quantum and Sundaram are these two funds which have actually seen a positive return in last 1 year, unlike the other small cap funds. So I just thought, let's take the one which has seen the biggest fall and also take the one which has seen a positive return in last 1 year. So let's look at LIC mutual fund small cap fund holdings. Hormus was talking about Allied Blenders being a big decline, seeing a big decline in last few days, and that is a stock in this particular fund. We have Apollo Microsystems, there's Precall, Naveen Fluorine, Sirma SGS Tech. This is one stock also which has seen a sharp fall. On the flip side, Sundaram small cap fund has seen a positive return in last 1 year. That has the likes of RateGain Travel Tech, there's Apple, Craftsman Automation, PNB Housing Fin, SGS Enterprises, and EID Parry. Let's talk about the mid-cap funds, because they've not fallen as much as small-cap funds have fallen in last 1 year. In fact, some of them have seen positive returns as well. So we have the likes of Con mid-cap funds, which is down 7%, Helios mid-cap funds, which is down 6.3%, HSBC mid-cap. But these are also the funds which have seen some positive returns. For instance, Mirae Asset mid-cap fund has seen return of 10.5% in last 1 year. We have HDFC mid-cap fund, which is up 10% in last 1 year. Again, we do the same exercise, look at holdings of some of these funds. For instance, Con one Midcap fund has Premier Energies, Tatacom, there's Auto Pharma, IRB Infra to name a few. On the other side, we have HDFC Midcap fund. Hormus spoke about Union Bank being a big gainer. That comes into this list. We have HPCL, which is up 30% in last 1 year, Indian Bank, Coforge, to name a few. Now, let's talk about the cash holdings by some of these AMCs. This is a percentage of their overall AUM. PPFA tops the list again. It is around 22.3%. It is followed by Quant MF, which is also sitting on cash holdings of around 12.6%, followed by White Oak, Motilal Oswal, Trust Mutual Fund. HDFC MF has around 6.8%. Quantum MF also has some cash holdings. So this is just to tell you that, of course, the broader market fall has impacted mutual fund investments as well. And these are some of the top funds in that category.
Thank you very much, both Hormus and Sonal, for that. Sandeep, let me just take up one of the points that Sonal was talking about. The Quant Mutual Fund has a cash holding of about 12.5%. Is that correct, or is that as of December and in the last 2 weeks you all have been deploying?
No, it is marginally improved only. So it is not declined. Actually, we have booked some profit. So it's the cash level has actually moved up.
Okay, got that. And just, we started this discussion talking about the broader macros in the global markets, etc. I mean, now the big risk is that maybe the global markets also there could be a trend reversal. Maybe they will also correct, because up until now, the mother market, US, has been very resilient. There may be some complacency in the way they have digested everything that's been thrown at the market. How big a risk is that globally there is a shake-off?
So this is the point which we have been highlighting. The worry is not India. My worry is global market. My worry is US. And my worry is even NASDAQ also. Okay. So all this AI stock, which has done extremely well, I think that is the risk. And I said on the forum, I talked about NVIDIA could be the best shot for this year. Now, the way we have to look at is that obviously India has underperformed for last 6 quarters or so. We had a negative correlation in this market, which means if global market corrects, we can also correct a bit, which is the case right now. But what is very important is that we have a probability, I will say, based on our analytics, that India in 2026 will outperform the global market, which will be the inverse what we have seen in the past. So it's a very important takeaway with a lag effect. Money will shift to India. It's a very normal thing, if your risk appetite is peaking out in these markets and India risk appetite is on the lower side and it has been lower on lower levels for a while, I think money tends to shift. It may not shift on immediate basis, but with a lag effect of quarter or month sometime, maybe let's take a quarter sort of thing, then I think money will shift to India. So if somebody asks me how you see year 2026, yes, challenging, but whether it can give you positive return if you have patience, the answer is yes, India will outperform. And if you construct your portfolio, some of the areas which we highlighted, you have potential to actually generate alpha out of it. Only thing is that you have to get out of your personal biases which you have built or last 2 years some of the stock the sector has given. So people are still carrying those memories and say this is the stocks which have done extremely well and these are best performing stocks or sector. So I will look for buying opportunity. That may not be very effective this year.
All right, Sandeep. So you're talking about a PE de-rating, possibly that, PE contraction actually. The globe could be in a bit of a flux. NVIDIA could be one of those top short calls, but India could relatively outperform if you have some patience and in the coming quarters, if the flows do come back. That said, Sandeep, if you have to turn decisively positive, what would that trigger be? There's this hope of the trade deal. Number-wise, it doesn't mean so much, but sentiment-wise, it means a large deal. We have the budget that's coming up. And obviously, the hope is that earnings actually return to the low teens to mid-teens. So if you return decisively positive, if you could state down a few factors on our markets.
See, first of all, the trade deal, obviously, it's less important from numbers perspective, but more important from a behavior perspective or psychological perspective. It's something which is hurting and disturbing. But let's say what can change, okay? So I have highlighted this year the risk will be on the dollar value where dollar can spike, which can affect global equities. if dollar continues to remain weak and this call which we are making fails, because right now this year is all about dollar supremacy battle, which we are seeing with what we saw in Venezuela, what is happening in the Middle East and some of the areas. This is the pain point. If that thesis fails, that risk does not play out, then that will be act as a big trigger for equity market and emerging market in particular. That's the one trigger. Second thing, if government does something drastically, okay, on the taxation front or the budget, which I don't believe so, but if something like how GST thing happens, and if that is the case, and they can do some changes on the long-term thing, which is the expectation from the market, that can be a game changer. But does not look like, because government has been very clear how to make changes in from both long-term and short-term and different asset classes. And third most important trigger obviously is about earnings. We believe that September to December quarter earnings have bottomed out, including the tech space. So base effect will also play a very important role. The second half, which we talked about, will be slightly better because of the GST and the tax rationalization. So I think going forward, I'm more optimistic on the earnings cycles, which will pick up actually as compared to when we turned negative in July 2024. We thought that the cycle has peaked out and it played out quite well. So I think we are again in the early stages. The key driver for the market is always about earnings. And if you believe that earning momentum can gather up, or certain sector, certain pocket where you see visibility, let's say sector like energy space or the banking space or the insurance space. So many sectors are there where we have seeing a clear signs of visibility in terms of earning expansion, and the P are not that high. Rather, we can see a peak expansion also some of these names. So I think that then you get a winner in these space.
Okay, all right. So, in terms of themes, you're talking a little bit about banking, pharma, energy as well. And I recall when we had the forum, I'd asked you if you had to buy between two stocks, a staple stock at 50p or an EMS stock. Between the two, it would be staples. But otherwise, if you to pick up your top theme where you all are relatively overweight in comparison to the index, which would that theme be?
Right now, we are significantly overweight on financial, and within that, banks, the private sector banks, because we think public sector bank has played out the opportunity now in private sector banks, and insurance company, which are in the deep neglected phase.
Okay, banks and insurance companies.
And in the mid and small cap, you gave the broad framework on how one should construct their portfolio. But can you break that up into a little, sub-themes or segments? Which ones do you like? Which one? I know it's a lot to do with individual stocks, and you've spoken, at length about that's the way to generate alpha in a challenging market like this. But just some broad ideas in terms of a sectoral tilt to mid and small caps?
So obviously, if we're talking about, let's say, pharma as a theme or power as a theme or consumption, like Nigel talked about FMCG, so you have to drill down and identify stocks in the mid and small also. There are many stocks which have been neglected for a while. They have their earnings, because of earnings compression, they have corrected a lot, and with the GST benefit, we believe there will be a potential on that side. So which means you have to dig and you will get some opportunity, provided you should have some amount of patience, But the challenge in the industry market is people who are so used to in last many years for the quick returns, and which you don't get, then people tend to get frustrated because the markets are not working. So if you go back and say we used to be very happy with 12-13% CAGR numbers, so you have to bring down your expectation, and the market looks good from a medium to long-term perspective, provided we are also willing to change our mindset and our approach in identifying the sector or stock, and because the expectation level has been significantly high, and that is something has to be toned down.
Okay, all right, Sandeep. Well put, and a good note to end this conversation on. I think that 2020 to around 2023 odd mark, at that time people got very used to that 15, 20, 25% returns. So moderate your expectations, and then in fact, the markets could actually look up from here on. Appreciate you joining in, Sandeep. Wishing you a good rest of the day, and we'll catch up soon. Thanks for joining in.
Yeah, thanks for inviting.
Well, time to slip into a short break. On the other side, we'll turn the focus on Kalyan Jewellers and Eternal. They are some of the top stocks that are moving around.
Welcome back. Still tentative for the markets. Indices are down close to about 0.4%. This would make the third consecutive session of declines for the equity market. But as that intraday chart will tell you, after breaching that psychologically important mark of 25,000, going all the way down to 25,900, there was a remarkable recovery between 11 and 1 o'clock. But now, markets are still looking a bit iffy. Midcap index down 1.5%. How should you position yourself then in the last hour of trade? Mitesh Thakkar is now joining in. Mitesh didn't quite get to that 24,400 mark to initiate a fresh short, but it's been all over the place. Very, very volatile trading session. What's the trade that you've taken today or you recommend?
So, good afternoon. I think the idea remains that, we have a strong chance of heading towards 24,650, 660 zone, thereabouts, give and take a few points. Also is the fact that now I think the marker on the upside has shifted to 25,400, 25,380. I think any bounce is closer to that level would be a shorting opportunity. And until we start getting closing above 25,400, 450, I think I would maintain a negative stand. So still a weak market for me, despite the fact that, I'll tell you, my sense that some kind of jump is also coming from the fact that the PCR was extremely oversold in the morning at about 0.58. It will still get oversold. So I think there's still a chance of a bounce back coming. But again, the structure is weak, so I would not want to go low. But I think once the bounce back plays out, around 25, 350, 400 zones is where I would explore shorting opportunities. On the stock side, sorry.
No, that's it. We want your stocks well put in terms of the setup. And you've been maintaining that, right? That you're not very confident that the market is going to bounce. And now you've given us that level as well, 25,450. That's a crucial mark on the upside if you have to feel good. Otherwise, slippy slide to around 24,650. Individual stocks, Mitesh, go for it.
I have a sell on Indus Tower with a stop at 421 for targets of 400. And BPCL is a sell with a stop at 357 for targets of 335.
Got it. All right. Thanks a lot for that, Mitesh. Well, let's hop across to Mangalam. He's here to tell us about Kalyan Jewellers. It's lost its sparkle today. Mangalam, tell us more.
Not just today. In fact, Kalyan Jewellers is down for 8 straight sessions. And today it's down in double digits. If you look at this week itself, the stock's down over 15%. And from its peak, it's down over 36%. The important part is that, there are 3 major reasons why the stock could be lower. One is that the churn that has taken place at one of its top fund holdings. So if you look at Motilal Oswal Midcap Fund that held about 6.3% stake as of last December, that stake has increased to about 9%. If you look at other institutional investors, Franklin has maintained its stake at a little over 1.3%, whereas Sundaram Midcap Fund has decreased its stake to sub 1%, which is why it's not visible in the latest shareholding pattern. And the government of Singapore too, their stake has come down from about 2% to 1.75%. So churn in some of the largest shareholders of the company at the top of that is something that's spooking the street. The other part, with the stock having declined, remember the promoter stake, which is at a little under 63%, 25% of that is pledged. Remember, this number same time last December was around 19%. So over the last 1 year or so, the promoter pledge on its stake has increased from 19% to 25%. Remember, in August 2024, the promoters had bought about 2.5% stake from Warburg Pincus at 535 rupees. That's when the pledge on their stake was created. So with a big decline in this stock, could there be some of those incremental pledges being called for, and as a result of which could we see further downside on Kalyan Jewellers or not, is the big question. And this question is important because nearly 6% of the company's stake is held by retail investors. 5% was the number same time last December, and now the numbers moved to 6%. And if you look at the number of retail shareholders as well, it's grown by about a lakh, 5.59 lakh last December. Now that number has gone up to 6.6 lakh. The only thing that we'll have to monitor now from here on is that with this underperformance and the huge rise of shorts in the stock, does it go into F&O ban or not? We've seen periods of big declines in Kalyan Jewellers, and this is even more so at a time when gold prices are higher and all these companies are reporting stellar quarterly updates. So this is definitely more technical in nature than fundamental, and the stock continues to decline.
Got that. What about Eternal? Making big moves ahead of the Q3 numbers. Typically comes out by 3:15. So anytime now, yeah, go ahead.
Anytime now, it's making big moves. But just to put those big moves into perspective, it's up around 6% ahead of numbers today. But the stock from its peak has actually, despite having moved about 5% today, corrected about 23% from the top. The revenue that the street is working with, 14% quarter on quarter. Remember, same time last quarter, the second quarter, there was a big jump versus estimates year on year because the company had changed its inventory model for Blinkit. So we have to be mindful of that. Look at the numbers quarter on quarter. The street's working with a 14% up move on the revenue, 15,500 crores. The EBITDA jumps by 26%. The number you're looking at is around 300 crores. And the net profit at around 102 crores. These are all numbers quarter on quarter because year on year, the reported results are not comparable due to change in Blinkit inventory model, which was earlier third-party inventory, now will be owned inventory. Food delivery, net operating or net order value should grow anywhere between 12 to 15% year on year, and Blinkit GOV will be up 120 to 130%, or NOV would be up 120 to 130%. Either way, that's the GOV that gets captured in the reported revenue because of the new models. I'll be looking at the trend for the food NOV growth and whether there is a decline in Blinkit's EBITDA losses despite the investments that they're making in quick commerce. Any commentary around gig workers will be very crucial. And another number that I'll be watching out for will be the cash balance on their books as well, as all the competitors have gone ahead and raised funds. Eternal at the end of the last quarter had about 18,300 crores of cash, which is pretty comparable to what Swiggy has post its QIP and what Zepto has as well, as per reports.
Okay, all right, Mangalam, thanks a lot for that. By the way, keep an eye out on a few stocks. I think there was some news on Raymond's redevelopment project in Badala with revenue potential, I think, of 4,000 crores or thereabouts. What volatility? The stock went into the green and it sold off quickly from there. I think the intraday chart should come up for you of the stock. The Raymond stock should come up for you on the screen. It was spiked up and it's come back down. So, it went to 455, back down to around 440 rupees. That's the kind of volatility you're seeing today. And Thangamayil Jewellers as well. I think it came out with a set of numbers. Immediately the stock spurt up close to around 3-4%. And then it sold off. It was down close to around 3%. And as we speak, it's more or less flattish. So big moves. Intraday stocks are moving today nearly around 6 to around 10%. And it's being considered a bit of a norm. Well, you've got some news at the bottom of your screen. JB Chemicals, Nikhil Chopra has resigned as a CEO of company. That's a transition, new promoter coming in there. I think that was more or less on expected lines. The street was expecting this to happen. Well, we'll take a break, come back, continue our focus on markets, and we'll focus on select stocks as well.
Welcome back. The conversations continue here at Davos 2026 as we count down to President Trump's arrival, which is now going to be delayed by a few hours on account of a technical snag, and he gets to Davos later than what was expected. But to talk to us about all things tech and AI and what that means specifically for Indian IT services companies like Infosys, joining us here in Davos, Salil Parekh. Always a pleasure, Salil. Thanks very much for joining us. You know, you're fresh off a third consecutive quarter of a beat and raise. How confident do you feel now about 2026, given all the uncertainty?
So thanks for having me here, Shireen. I think we are seeing a good outlook for the next year. What we shared a few days ago, financial services, we see next financial year better than this financial year for us. Already in this year, we are starting to see discretionary work in financial services, which is good. I'll come to some of the other industries. And energy and utilities, we see a better outlook for next year than this year. Then we see a lot of work in AI. We've identified 6 areas where we see a lot of growth opportunity over the next several years. And some of that will start to happen next year. And then overall, as you mentioned, we had a good quarter, an increase in the revenue guidance and a steady execution with our margin guidance. So we feel quite good going to next year.
Well, you know, let's double down on this AI opportunity in the AI landscape, Salil. You're pitching AI, your enterprise here in Davos. That's the theme and that's your tagline here for Infosys. But what does that mean exactly? Now, if I take a look at some of the numbers that you've thrown our way, you say that over 90% of your top 200 clients, you're working with them on some AI project. You're working on about 4,600 AI projects today. But when you say AI, your enterprise, give me a sense of what this opens up for you as a revenue opportunity the next few years.
So there, Shireen, what we are seeing is, to give you a couple of examples, one in software development, which is our core area of activity, we see working with third-party agents and agents that Infosys has built, the ability to work with our clients, large banks, large utility companies, telcos, to increase the speed of doing software development and reduce the time. So a huge change. Another example we are seeing is a lot of companies have old technology platforms, starting even with COBOL. Now with AI agents that are available today and what we are building, you can compress the time and reduce the cost. What that does is many companies who are hesitant to take on those projects because of the economics are now doing those. We are actually working with some companies in executing that. So that's a new area of tech work which is available to us, which wasn't before.
Okay.
Now, these are not things which sound exciting, but they're big revenue opportunities.
And incremental new revenue opportunities.
Exactly. So these are all new revenue opportunities. In fact, in February, we will do an investor day where we will outline in a little bit more color what the specific revenue opportunities are.
Could you give us a little bit color before you get to your investor day on what these revenue opportunities could potentially look like?
So what we are seeing is a good set of these 6 revenue opportunities. Another example is in customer service, where we see a lot of AI agents working to change how customer service works, customer experience, even more than customer service. Then there is, we will also share, there are some places where there is a compression in revenue. What we are seeing across the industry in terms of tech services. And what we have started to see now is the growth opportunities larger than the compression opportunity over a number of years. And that's what we want to showcase in that investor day.
So what could all of this mean in terms of added revenue? I mean, are we talking about, you know, $1 billion, $2 billion, $2.5 billion over the next few years? I mean, what could all of this size up to?
So for Infosys, we will outline that this will give us a growth opportunity over the next years. As you've seen, in the last few years, the growth has been lower. Now with the last 3 quarters, things are coming back. With what we see also on the economic side, I mean on the global GDP, we've seen, for example, the US GDP numbers have been good.
Yeah.
We hear that the interest rates will further come down. With all of those, we see that typically spurs tech spend. And then we have the AI opportunity. So those are the things we'll outline.
So what are the expectations now as people go into finalizing budgets? What are you picking up from the clients that you are dealing with in terms of what it could potentially lead to?
So there, what we sort of were discussing earlier, in financial services and energy utilities, we see our next year growth better than this year. The next year revenue better than this year. So that's already a good signal. The rest, we're still working through it. We still see difficulties, for example, on some of the retail, some of the telco, high tech. But on balance, as an overall picture, we see a lot of opportunity. Yeah.
You know, again, and I know it's hard, but I'm still going to try, quantify this AI opportunity. I mean, what is the size of the market that you're going after, for instance, and what could we realistically expect you to deliver over the next few years when we talk about this big AI opportunity that you, your peers, everyone's talking of?
Yeah, so there, we will highlight that in this Investor Day by going into each of the 6 buckets. What we see today is more that the growth over the next 5 years is something we are looking forward to in making sure that if we pivot our work to it. So part of it is also making sure we make the right investments. We are putting a lot of effort into building out capability, building out the partnerships, and making sure that our own people are skilled in that area. And that will give us the growth.
So,
well, hard to quantify the AI opportunity as of now, but companies are preparing for it for the long haul, making the right investments. But back to the market, a sore point today is the continued weakness in the Indian rupee, touching new low after new low. And today the low was 91.73 against the dollar. Lata is now here to just take stock of the kind of foreign selling, the sentiment that's affecting the equity markets, and what the RBI has been doing. Lata?
Well, the story is familiar. Foreign funds are selling Indian shares, buying dollars with that money and repatriating it. And that's the same thing. At the rupee was already on that weak wicket where capital flows are not able to bridge the current account deficit. But what has exacerbated it is this kind of risk-off in the last 24 hours across all financial markets that hurts an already bearish asset even more. We did see the Reserve Bank supplying dollars, but when there is a cascading selling of buying of dollars by foreign funds who are marching out, the Reserve Bank wants to preserve the ammunition, so they weren't supplying in huge amounts. Another factor is that month ago contracts entered into the NDF market is maturing, and that leaves a lot of Indian banks in short dollar positions. That creates pressure around 1 p.m. when you have the fixing of the dollar rupee rate for the day. That added to the pressure. So we saw the rupee at its weakest around 1 p.m. There is little to redeem the pressure on the currency. We can only say that at the moment the rupee fall also has strengths. We mustn't look at it as a matter of despair because it makes imports expensive and therefore protects domestic industry from cheap Chinese imports fundamentally. Because while we have fallen in the last year or so about 5.5% versus the dollar, versus the renminbi, the Indian rupee has fallen nearly 12% in the last 8 months or so, or in the past year. Therefore, this has its positive payoffs from the import scenario. Exports also become more attractive, but that, of course, are usually annually renegotiated contracts. Short point, when there is a sudden sharp fall, all these positives kind of pale into insignificance because even those who want to bring dollars don't bring in. Exporters stay back. They want to sell later. Importers rush to cover. And foreign investors also wait to see how much the currency falls. Why would they want to bring in something when the asset is depreciating? So sudden sharp falls don't help anyone. But in the long run, the answer to all the instability or differences in prices is a falling rupee. It's also a solution, but not when it is a sudden sharp fall.
Thank you, Lata, for explaining that. As you said, it's a familiar story, what we've seen transpire in the equity markets, in the currency market, the rout in the equity markets and the persistent FI exodus is not hurting. Mayuresh Joshi from MarketSmith India is now joining us on the show. Mayuresh, in the last couple of days, we've seen markets indices give up 4-5%. Individual stock levels, it's been a fall of more than 10% in so many large caps also. How have you used this opportunity to rebalance your portfolio? Where have you bought? Have you trimmed your positions anywhere?
Afternoon, Rima. No, I think there has been quite a rebalance at markets with India. I think we got stopped out on a few positions. We booked out on a few positions as well. But I think a couple of sectors which are still doing relatively strong, in our opinion, as we see our institutional software, Panray, exhibiting a few sectors showing very strong trends. One is within the consumption basket, FMCG players. FMCG players not only will act as a defensive basket in these volatile times, but with expectations of better numbers expected to come through in this quarter and the coming few quarters as well, both in terms of volumes and value. I think you can probably expect some element of relief happening on this front as far as the EPS, RS rating and earnings generally are concerned. The second pocket selectively has been the strength in PSU and mid-private sector banks. Our own sense is that numbers have been very encouraging so far. And going forward, again, I think with asset quality pressures remaining benign, capital adequacy remaining extremely strong, and expectations of stronger growth dynamics displayed on the balance sheet, I think a few of these players might actually exhibit strength. Metals had a strong show, specifically base metals. Our own sense is at this juncture, ferrous players might start making a bit of a comeback within the space itself. The drawback duties that have probably got announced in terms of safeguard duties will not only aid top line growth, but also utilization levels should start inching up higher than 80%. With a lot of captive mines at the disposal of a lot of listed players within India, absolute reported EBITDA and the EBITDA per ton should start showing signs of improvement. Our own sense is if the EBITDA improves anywhere between 1,500 to 2,000 rupees, you should see an incremental 3 to 5% increase in terms of EBITDA. And on long-term averages for ferrous players in general, they used to trade at 6 times EV EBITDA. Our own sense is that they should come to a normalized level of 7.5 times. So I think these are the spaces that might actually do well for a mix of factors based on each individual sector.
Okay, all right. Got that. In fact, we want to talk a little bit about those ferrous names, but just pull up Dalmia Bharat. The numbers have come in and they come in more or less in line with what the street was working with. So on the top line, we have the revenue number that's coming at around 3,500 crores approximately. That's more or less in line with what our poll threw up. And also in terms of the operating profit, it's ballpark around 17%. So on a year-on-year basis, that's actually been an improvement, which was on expected lines. However, on a sequential basis, there was some pain as well. The stock is reacting more or less flattish because in the last few days, the markets have corrected, but Dalmia Bharat actually has been unmoved. The reason is that in the coming quarter, the street believes that things will improve from here on, and East India has seen a lot of pressure on pricing. You know, the pricing has down close to 10% on a quarter-to-quarter basis, but now there is hope that there will be some kind of recovery. So in the last few trading sessions, the stock had run up a little bit, but just to give you the numbers, revenue growth of around 10%, margin expansion of close to around 100 basis points comes in at around 17%. We'll try to get you further details, but for now, it appears more or less in line. The optimism is on quarter four's numbers, so let's see whether or not they can deliver. Pricing is good, demand has been quite strong as well, and they've delevered their balance sheet. But since Mayuresh spoke about steel companies, well, let's tell you what Morgan Stanley had to say on steel. They've come out with a few stock calls. On JSPL, they've been overweight, trading target price of around 1,250. They've been underweight actually on sale. 140 rupees is the target price out there. And they maintain their overweight both on Tata Steel as well as JSW Steel. And those target prices come up for you on the screen. The factors at play. They remain constructive on steel spread expansion from here on, which is good. The domestic steel prices, they have recovered significantly post the policy tailwind that we saw. So that's good news as well. You know, some brokerages have also written that we have seen price increases, but there's more to come, which is heartening to see because so the top line growth will be there as utilizations levels pick up and as pricing as well improves. From the China perspective, they say China's anti-involution is a medium-term theme. So that could be another tailwind because we know that China, they have been exporting non-stop close to around 10 million tons on a monthly basis. And finally, they're also going to say that the global macro factors remain supportive. So put all this together, Morgan Stanley, fairly optimistic on the prospects of steel stocks. Mayuresh, I think, you predicted or you preempted what I was going to talk about. So you already told us that you believe that steel will improve from here on. But tell us about cement. Dalmia Bharat has come out with its numbers, not expected to be any great shakes. But it seems the street actually is looking ahead from here on. They are saying quarter four is going to be good. Volume growth was good in December. That's continued in January. I have my ear on the ground and I believe that demand has been good. But what is heartening to know is that price increases have gradually been pulled back. And if this globe is going to go into a flux, you want to focus on domestic themes. So would cement be on your list?
Collectively, yes. Afternoon, Nigel, to you as well. I think numbers have been pretty much in line with expectations. I think the numbers which have come out so far, Dalmia Bharat, more or less in line, as you rightly pointed out. JK Cement was a decent set of numbers, as pointed out, and there are plans to probably take it to 40 MT over the next few years, in the next 3 to 4 years. Probably seems to be on track. Therefore, our own sense is that as volumes improve, as realizations improve for the sector as a whole, with input costs remaining benign. And a lot of these players are doing backward integration as far as their power requirements are concerned, and the captive mines thereof as well. That would largely lead to a better EBITDA number on an absolute basis. And relatively, I think as leverage starts kicking in on an EBITDA per ton basis. The kind of additions that they've probably done, both in terms of quicker capacities in general for the industry as a whole, and generally capacity expansion, which are also close to either logistic or hubs which are probably more favorable for transport. I think that probably also ensures that efficiencies start kicking in. And therefore, with all these levers in place, I think the next few quarters should be pretty interesting for the sector as a whole. So I think, again, when we look at our EPS rating rankings at Markets with India, I think a couple of stocks which stand out. JK Cement from the Midcap Pack is a definite standout that we probably got. Among the large names, Ultratech probably remains on our watch list.
Quick word, Mayuresh, Restaurants Brand Asia, it's been a rank underperformer since its listing. In the last 5 years itself, share price is down 50%. But with a change in ownership, a fund infusion of 1,500 crore, would you bet on a turnaround and buy the stock?
Rima, not at this juncture, because I think it's gone through a terrible phase of underperformance, and numbers have been nothing great to write home about. And therefore, I think the entire re-rating of this stock will be based on numbers which will start coming through and consistent improvement on thereof, which will give the forward multiples something to speak about. But at this juncture, I think both these aspects are not in favor of Restaurants Brand Asia. So I think give it a pass at this juncture.
Okay, all right, Mayuresh, meet me for a burger. Sometimes it's on me. We'll decide the brand later. But thanks a lot for joining in. Have a good remainder of the afternoon, and we'll catch up soon. We'll take a bit of a breather on closing bell. Stay tuned. Abacus Assets, Aman Chawan will be joining in on the other side. Stay tuned.
Welcome back. 30 minutes to go to wrap up trade. 25,150 on the Nifty. But what about the F&O positions and the trends? Nigel has now walked over to the F&O desk.
Well, Rima, we've seen a bit of a bounce, and the bounce has come from extremely oversold levels. But otherwise, the markets are still a little bit skittish. And I think first we need to see some kind of stability with regard to the Indian rupee. That's the key trigger from here on. We can't have this depreciation non-stop. Just a couple of months ago, we were holding at around 88, and now in no time, we're close to around 92, which is a bit of a worry. So that's one crucial factor. The VIX, it's spiked up, but it's still very far away from those fearful levels. So it's holding at around that 14% odd. I think the next mark on the VIX that the traders are looking at is around that 16, 17 odd mark. Till then, I think still believe that maybe in fact we could go through, get past this stage with a bit of consolidation. The call writers continue and they're having a blast. 25,300 call. Just take a look at the premium. It's eroded by close to 32% after nearly halving in the last 5 days or so. So that's now down to around 100 rupees. Pull up the 25,000 put. Now there the premium has gone up by around 50%. Premium last I checked was close to around 90, 95 rupees or thereabouts. So there is some signs of writing on those levels. So the important mark will be today's low, 24,920. That's the first reference point, 24,900, 24,920. On the upside, going by the options data, and where we earlier took support, that will become a resistance now, 25,400, 25,500 odd. Individual stocks, though, they are doing a thing of their own. Samudra Motherson, that's actually seeing a mild short covering bounce in today's trading session. So good going out there. Eternal ahead of its numbers. There is seeing some fresh buying out there. So there is some built up on the long side out there. And finally, on Oro Pharma, that's one of those pharma companies, actually, they're seeing good amount of shorts that are creeping into the system. So there's a big surge in terms of open interest. The stock is down as well. The shorts are sniffing something. So for the time being, we live to fight another day. 24,900 is important. First reference point on the downside. A bounce in the lows, but not out of the woods. Back to you, Rima.
Thank you very much for that. Aman Chauhan, fund manager, Abacus Asset Manager, is now joining in. Aman, just earlier today, we had a chat with Sunil, and he was saying that he'll stick his neck out, and perhaps this is a good time to look at individual stocks, even, mid caps, small caps, large caps, which meet the criteria. So weigh in with your assessment of the kind of fall that we've seen, persistent pressure in the rupee. Where are we headed at a headline level, and what have you all been doing? I mean, particularly the portfolio that you manage.
Sure. As far as the rupee is concerned, even we are surprised negatively as to the way it has been depreciating, because on the economic side, things are improving. Trade oil is low, so it's not that something that we have a big pressure on the trade side. And hence, that is something which has been a worry for us also, because that dampens the sentiment across the board, right? And that is one of the major reasons why we are seeing the sell-off in the markets today. It's not that FI selling has happened just now. It has been there since some time now, right? So the panic that we see over the last 10, 15 days is not just linked to FI selling. Overall, the sentiment has not worked on, and people need trigger. We feel there's enough liquidity in the market. People are looking at market. They have the cash with them, just holding on. Once they see markets starting to stabilize, to move up, when they start seeing money being made, they'll all come in, and somebody has to take a call. And that's what Sunil mentioned, that some sectors, some stocks, they're down 30-40% from the peak. Definitely, what we did not buy earlier because of valuation reasons now seems to be attractive, 30-40% lower, and one should start to look at it. These are panic times. This is when somebody has to utilize or make good of the panic, and that's what he mentioned. That's what we believe in.
Hi, Aman. Good to see you in. Markets are tricky, right? But at these tricky stages, when you get the stocks that you want at your prices, and hopefully those prices are here. Otherwise, in fact, there could be further pain for the remainder of this year. That said, let's talk about a couple of sectors and themes. Banks, that's a consensus buy. Banks as well as financials. How are y'all approaching that pocket? Are y'all overweight out there, or are y'all underweight? And what's the preference between, private, public, NBFCs, or within that, there are a couple of themes like gold financiers, if you like?
So you can say we are equal weight to overweight. In some portfolios, we would be overweight. Preference is private versus PSUs, though we own top PSU banks also. Within financials, we also like NBFCs and across the board, including the capital marketplace. So we have some AMCs, some wealth management companies, some broking companies in our portfolio, continue to own them, like them. On the fringe, we have added to mid-cap banking names also in the recent times. And the outlook, as we all have been discussing, has been pretty good on this side, and you're right, it's a consensus trade and seems to be working as of now.
So these are the things that, themes that you like, but particularly in the last 15 days, where do you think the correction perhaps has come to an end? The valuation derating may have bottomed out, and you have actually bought stocks or, themes. Can you give some more color on that?
Broadly on the EMS front, I think correction is more or less behind us. Things should start to look out. Cement names also, if the demand has to pick up from Jan-Feb onward, that's what people have been expecting, that ahead of the March and demand picks up, the government spending also picks up, then even cement stocks which have corrected have a good scope to move up. Metals have been doing well, so I'll not say there's a big opportunity there, though constructively we are pretty positive on that sector. With Rupee continuing to depreciate, there can be a trade or there can be bonds in IT also, especially the mid-cap IT name, because there the growth rate is also pretty decent, right? So, and plus they benefit from the currency. So some mid-cap pharma names, they have corrected 20-25%. This is more of a quasi defensive sector. If you have a 25% drawdown in a pharma name, and there are some names out there which are corrected more than 20-25%, that clearly looks like a buying opportunity to us.
Looking at the Dalmia Bharat numbers, Aman, and as you mentioned, cement could be a counter trend. We have been just covering this out here, that with the globe in a flux, you want to look inward. And when you look inward, you want to see a couple of sectors that are actually coming off a rough patch. The last 4 months were rough for cement. Now demand seems to have picked up, both trade as well as non-trade, and pricing environment is improving. What will your approach be? I'm sure if you could name stocks, it would be brilliant. But otherwise, what do you like? The East companies, where pricing took the hardest hit and now they're bouncing back. Or do you like the large cap names, the big daddy? Or maybe you want to play some of these takeover candidates. How are you approaching the theme?
So we have the big daddies, when also we are centrally paced. We don't have a very clear preference towards east or north or south per se. For us, it's more of bottoms up stocks individually where we see earnings tractions better than what the industry will be. So in the portfolio is more of large names as well as some central names. East is also something that we like, but these stocks are not very liquid for us to get into them, and hence not part of the portfolio. So in nutshell, more of individual names rather than having a preference for a certain region.
Okay, all right. Coming in late into the conversation, guys, but
jumping straight in.
Jumping straight in, right? And thank you very much for joining us, Amit, and good speaking with you. Well, I think D Street Chatter is next, and Nimesh is now joining in with what he's picking up. There's been a sharp recovery from the day's low. But at one point we were up 50 points. So at the day's high, the Nifty had bounced about 400 points. Some of that sheen is gone. But what's happening? Nimesh, take it away.
Hi, Prashant. So a small bit of recovery in the last, couple of minutes of trade essentially could be to the fact that there is an MOC buy basket at LNFI desk. I spoke about this at 11 a.m. as well, that, post 11 a.m. There was a bit of a pullback because of the margin calls got triggered in the first couple of hours, and there was a bit of buying as well. So maybe that's playing out in the Nifty, but broadly from a broader market perspective, there is a lot of pain and clearly signs of capitulation now. The mid-cap index is down another 1%, but there is a lot of lot of pain in the broader market stocks, the mid-caps and the small-cap names, and now there is clear capitulation from retail, HNIs, family offices, HNI, even for that matter, small PMSs and all. It looks like there is a bit of selling coming in from those sides. So that's clearly in the broader market names. As I said, a small MOC basket buying, so maybe it will have an impact in the last half an hour of trade. But purely, there is technically we've broken some crucial support levels. So till the time it bounces back to about 25,450, doesn't look like there will be a very strong momentum for this market. Today, the buying seems to be largely in large cap names and a bit of selective into the PSU bank stock. So that was a color as far as flows are concerned. But I guess barring the Nifty pullback, the bigger pain seems to be in the broader markets.
Nimesh, anyone is thumping the table and saying this stock or that stock?
Very difficult, Prashant, With thumping the table, people are...
Nobody's pointing to, this, look at that, and the stocks are being thrown away. No, nothing of that.
No, nothing yet, Prashant. People, there is a bit of scare now, clearly, the kind of sell-off we saw in the broader markets.
I think they're slamming the table and saying what's going on.
Nimesh, the other thing...
Today, Prashant, in the last 4 hours, I'll tell you, the feedback is every sort of investors had a bit of a relief. Okay, I sold out and the stocks have fallen, so wow, it's a relief for me. And if there is a pullback, oh, there is a pullback, so there is a relief. So, in both sense, it's just a small relief, but there is a lot of pain beneath. So I don't think anybody is right now in a mood to say thumping buy or give a thumping idea.
Yeah, no idea.
No idea.
But that is typically a good sign, right? I mean, no one. But you used the word capitulation a few times, and usually what comes after capitulation is a period of consolidation, and then maybe things start to look better. Has the rupee come up in conversations with
it has, Prashant. It has. So that also has an impact on the overall sentiment and the fact that FIs are not going to buy. If they're not large sellers, they're at least not going to be come and buying India market. Also, the fact that a lot of dealers who advise the global funds, they seem to be believing that right now none of the global investors are in a mood to buy India market. There is so much momentum in Korea, other Asian markets, and they're doing so well that nobody's looking at India per se at this point in time. So clearly, India is out of the favor for the FIs. And what is the painful point is that there is a lot of capitulation from retail HNIs, super HNIs, and the newer sets of PMS and AIFs who have not seen this kind of volatility in the last 4 years.
Okay. Now let's get to stocks, because there are stocks, Nimesh, right on your list. What are they?
Oh yeah, so the first stock on my list is BEL. A bit of a contra buying is what I understand now from larger FIs, and especially when leading long-only fund seems to be accumulating in the last couple of days. Could be a play for the budget as well, because there is a bit of sense that there will be some focus on the defense side, at least in this budget. So that is something which at least some of the global funds seems to be playing. So that's clearly playing out in BEL. So that's the first name. But again, large part of my stocks are largely to do with the flows. So nothing much in terms of M&A. Large part of the M&A is what we've covered in the last many days. But so BEL clearly is one stock which stands out. The second name is HDFC Bank. Again, I'm saying a bit of contra buying because one, some long-only funds are active buyers, and also one of the leading family office has actually turned buyer in HDFC Bank at current level. So the broad sense is, as I said in the beginning as well, the large flows are largely biased towards the large cap names and to some extent the financial names. So that clearly plays out. So HDFC Bank stands out in terms of flows today. Again, Prashant, there is not much in terms of very delivery-based selling or very large delivery-based buying. It's very, very selective and very, very, very specific is what I understand from a flow perspective. Raymond Limited is the other name. While you spoke about Raymond Reality doing good today, but in Raymond Reality, I understand one of the FPI holder who is a sovereign fund, they've been selling off late, and hence you're seeing a bit of pressure on Raymond Reality as well, Raymond Limited as well in the last couple of days.
And as I think Sunil Singhania was with us, Nimesh, no mention of the budget, right? By this time it would be frenzy. Budget mein kya raha hai, ye ho raha hai, wo ho raha hai, nothing, zero.
Nobody, I guess, is right now talking about budget, Prashant. Everybody's looking at their own portfolios and crying.
Okay, all right. But it's true. I mean, it's a powerful psychological feeling, right? When you sell and then stock goes down, well, the call was right. But then it goes up, and then you're you're thinking, well, maybe not so much. But selling begets selling, and there's that feeling, I think, which is also, of course, crept in, that if this is going to be and it's been, I mean, at the day's low, it looked like, I mean, just add yesterday's loss and today's loss, it would have been an absolute slam dunk waterfall kind of 2 days. Thankfully, we've got a little bit of a bounce. But that feeling that maybe there is more coming, maybe this is the start of another. India markets here have been correcting, but maybe for the first time, US has not seen any correction at all. Is this a global bit of a shakeout and things like that? With everything which is happening, all the comments we are hearing, so that element of fear, perhaps at the margin as well. Hopefully, things settle. There is that speech later tonight from President Trump at Davos. We'll see what comes out of it. We'll take a quick commercial break here. What to buy, sell today for reverse trades tomorrow. Mitesh is going to be with us for that. Stay tuned.
Welcome back. The other big development in the world of mutual funds is that Motilal Oswal's AMC Chief Investment Officer Niket Shah is all set to move to a new role as a managing director within the company's Motilal Oswal's group's principal investment business. Let's just quickly take a stock of the funds which are managed by him and which stocks those funds hold. Vinny is now joining in with the details. Vinny.
Hi, good afternoon. So talking about the funds that are managed by Niket Shah, it was quite a few over the years, more than a decade that he'd spent at Motilal Oswal as the investment officer. Now, Motilal Oswal Innovation Opportunity Fund, that's the lowest, and they have around 500 crores AUM as of now. Consumption Fund, 1,100 crore AUM. Arbitrage Fund, Business Cycle Fund, around 1,800 and 2,000 crore AUM there, while the bigger funds were the Multi-Cap Fund, which has around 4,500 crore AUM, Small Cap Fund, that had around a 5,800 crore AUM, and Flexi Cap Fund, a 13,800 crore AUM, while a Mid-Cap Fund, that was the largest one that was managed by him, was around 36,800 crores in terms of AUM. Now, let's look at the returns. Most of these funds are recent in terms of the launches that have come in the last couple of years, is what we could say. Except Flexi Cap Fund and the Mid Cap Fund, they have long-term returns as well. So when you look at the Flexi Cap Fund, in the last 1 year, obviously 1 year return is not something that you watch out for in terms of a mutual fund as a whole, but still 1 year Flexi Cap, Mid Cap funds have not done well. Previously 3 years they managed a 20% return for both these funds, while for Flexi Cap there's a 13% year on a 5-year basis, as well as for the Mid Cap Fund it's around a 26% return for a 5-year basis. Now overall, other than that, all these funds just have a 1-year return. The stocks that they hold in these funds, talking about the top ones, which are the largest AUMs, Mid-Cap Fund, Persistent System was among the top, holding more than 10% in terms of a weightage that came in. Coforge was there, 8.9%. We have 197 Communications, Kalyan Jewellers, as well as Dixon Tech among the top 5 holdings. Even for Multi-Cap Fund, Persistent Systems, Kalyan Jewellers, as well as Coforge still are there even in the Multi-Cap Fund. Other than that, there's Bharti Airtel as well as Shelley Engineering, which was among the top holdings. And Persistent System, Coforge, Kalyan Jewellers even makes the list in the Flexi Cap funds. So these are some of the funds and large funds which they were holding with their stock holdings for them as well.
Okay, thank you very much for that. And some of them have done very well. Coforge, Persistent, which are a part of the Flexi Cap Fund, have given very strong returns over a 5-year period. For the day, the mid-cap index is down over 1%, managed to recover in the last 30 minutes. Credit Axis Grameen is a big mover. MRPL, 9% gain on that. J&K Bank, we chatted with the management earlier. At least for now, the QIP is not happening for the next 3 months. The bank will look at it in the first half of FY27. Stock is up nearly 4.5%. ITC seeing some interest, very large volume, stock up 4%. Sudeep Bandyopadhyay, market expert, is now joining in on the show. Sudeep, thank you very much for joining in. Just wanted to get your thoughts in first on the 2 deals. One of them is Restaurants Brand Asia and the other one is Bazaar Style Retail and Cupid. Have you all done any analysis and is there an investment?
I think Restaurant Brand Asia wanted to, there was this deal in the market for quite some time. And I think it's good that somebody with some experience, at least in this entire space, has come in and acquired this stake. So it's good for this Restaurant Brands Asia. Overall, we are positive on the F&B industry, and we think there is significant scope for improvement of performance as far as Restaurant Brands Asia is concerned. We'll have to wait and watch how things pan out, but we are generally positive on this entire space. And of course, this has been very hot with a lot of deals happening in this entire space and pretty much a change of shareholding in almost all the branded food chains in the recent past. As far as Bazaar Style Retail is concerned, again, this is a space where we have been bullish for the last almost more than a year. We believe that this value retail is an area where there is significant growth opportunity. If you look at analyze the bigger chains who were into luxury retail, their value retail business, they have all started value retail business, and that value retail business is what they kind of help them to grow and help them to expand, whether it's a trend, whether it's a lifestyle, whether it's Shopper Stop, all of them, Reliance, all of them have the value retail chains. But having said that, we believe that value retail chains operating exclusively in smaller cities and towns have a significant scope for expansion, and bazaar style retail is one of them. This current deal, I think there are synergies and there are opportunities, and I'm sure this will be value accretive going forward.
All right, stay with us. Sudeep, coming back across to you, but let's get in Mitesh Thakkar, Bonanza portfolio, who joins us on the show. Mitesh, markets down 90 points, had a bit of a intraday pullback, but that got sold into. So tell us individual stocks, though, for a buy or a sell call.
So I have one buy and one sell, one BTST call and one STVT. On the STVT side is Laurus Labs. After a good rally, the stock is now showing first signs of correction. So keep a stop at 1001, look for targets of around 970. And on the buying side is JSW Steel. Keep a stop at about 1164, look for targets of 1190.
Thank you very much for that, Mitesh. Interglobe Aviation is seeing buying ahead of numbers tomorrow. December quarter was the quarter in which the airline got hit on account of a lot of cancellations, and then the airline had to issue refunds, etc. So numbers will be watched very closely. Get into a break. On the other side, more on the market closing. Welcome back. The Nifty is ending off from the session lows significantly. The low today was 24,900. So from that level, it's been about a 250-point recovery that we've seen in the second half of the trading session. But the Midcap Index, Nifty Bank ending with a cut of nearly 1%. Sudeep, open-ended question as we wrap the trade. Any stocks that are looking attractive now after the fall?
Well, I think from an investor's point of view who have 1 year plus time horizon, this is a great opportunity for picking up good quality stocks which have corrected significantly. I do like Larsen and Toubro. I think it's definitely worth picking up post this correction. I also like State Bank of India. I think, again, it's a great opportunity to pick up from a long-term point of view. As far as cement is concerned, I do like cement. But considering the overall risks in the market, I will stick to Ultratech, which I think is the best of the lot and the biggest of the lot. So I think some of these stocks definitely worth looking at current levels. Need not be picked up immediately, maybe picked up over a period of next few days because market is going to remain volatile now. But definitely good opportunity for building portfolio from a long-term perspective.
On that optimistic note, we'll thank you for joining in, Sudeep. Let's hope, in fact, this is that time that helps build portfolios and hopefully the pain is nearing the end. Thanks a lot for joining in. Well, time to wind down the markets. Last 60 seconds left. It was another day of trade where, in fact, the Nifty wobbled. We were down 250 to 60 points at one point of time. We did recover. The good news is, on a closing basis, we managed to conquer the 200 DMA. What didn't do well? The banks. They underperformed after a while. ICICI Bank did come in for some selling. So that was one of the top losers. Axis Bank as well was down in trade. What helped? Well, you had Eternal. The stock was up close to around 5%, and that was the top gain on the Nifty. It's corrected from 370 to around 280, but today it popped up in trade. Interglobe Aviation, well, the stock was up close to around 1.5%. Some kind of relief coming in with regard to that talk on capping fares. Besides that, metals did well. Hindalco as well as JSW Steel, both of them, ferrous and non-ferrous names, did pretty well in today's trading session. From the broader markets, Credit Access, Grameen, beautiful move out there. Stock up 9.5%. Veranda, well, that stock was up close to around 8% in trade today. Walchandnagar was up close to around 7%. And a whole host of names were doing a thing of their own on the upside. Even Wellspun Living, well, that was up close to around 5%. Deal, no deal, unsure. But, that one did end with some green.
Lower now for the third consecutive session to wrap trade. We closed off from the session lows, but down 0.25% on the Nifty and the Sensex. Midcaps down 1%. And the other big story was the fall in the Rupee. The Rupee hit a record low of 91.73 against the dollar. Tried to recover towards the end. Let's see where it closes. And what will the street watch post-market? Numbers from Dr. Reddy's and Eternal. And the other big one, of course, is the Trump speech at Davos.
Okay, well, it's a wrap on this edition of Closing Bell. From all of us, say goodbye. Thank you for staying with us. More comes up on Markets Forward in just a bit.
Wild swings on the Lal Street as Sensex and Nifty go on a roller coaster ride. A late recovery helped to recoup most of the losses, but all sectoral indices end in the red. Market capitalization of companies listed on BSE drops below 5 lakh crore rupees for the first time in 9 months.
Rupee sinks to a record low after posting the biggest single-day fall in 3 months. Sustained foreign selling of Indian equities and weak market sentiment take the rupee closer to the 92 rupee mark against the dollar.
SRF slips as pricing pressure from Chinese rivals weighs. United Spirits dips as volumes miss the mark. Shoppers Stop is hit by weak consumption, while Vikram Solar sees orders and revenue slip sequentially. Hello and welcome to Markets Forward, your go-to show where we aim to get you all the key data points to gear up for the next trading day. I'm Sonal Bhutra. With me is my colleague Vivek Iyer. Vivek, good afternoon. It was a choppy session. At around 12:30, we saw that massive recovery, almost 350 points from the lows of the day on the Nifty, but then that got sold into as well. Nifty finally ended below the 25,200 mark. We breached the 25,000 mark as well in trade today. Midcaps underperformed. That index was down 1.14%. In the Nifty Pack, 30 stocks ended in the green as we speak, and the advanced decline ratio, that was in favor of declines, but at a point in time, the ratio was 1:5, 5 in favor of the declines as well. So it's been quite choppy. Look at the advanced decline lines. They actually merged at every point, and finally it ended in favor of declines. But it's been very interesting, the session today, with wild moves across the board.
That's right. Good afternoon, Sonal. A very, very choppy session. The only thing that went up consistently was the India VIX. And in fact, like you mentioned, the intraday volatility actually extended even to a whole host of stocks, especially those companies that came out with a set of results. Towards the end of the trading session, we saw a name like Dalmia Bharat from the cement pack deliver a good set of numbers with strong volume growth. That did quite well. But overall, most of the results, especially where there was a slight miss, saw significant selling pressure. Names like Persistent, some of the names like United Spirits, all of these stocks saw significant selling pressure. Well, here's the lineup of what we have in store for you today on Markets Forward. We'll start with the top movers and shakers of the day with Hormas. We break down the reasons behind the rupee's record low levels, analyze key Q3 earnings, and explain why Kalyan Jewellers has been in a free fall for the last 9 sessions. Last but not the least, we'll delve into the key market events to watch out for in tomorrow's trading session. So first up, Hormas joins in from the wall for the top movers and shakers of the day.
Not for the faint-hearted. Please don't try this at home. You could use any form of disclaimer for today's trading session, considering the kind of moves that you had. But the recovery on the index today was led by Reliance Industries. And after a prolonged period of underperformance over the last 7 to 8 sessions, the stock ended 1% higher and was the chief contributor in that recovery from those panic low levels of 24,919. TCS was the other contributor along with Ultratech Cement. Both of these stocks ending with gains of around 0.5% to 1.5% as well. So some green seen on some of the index heavyweights in today's session. Earnings were a mixed bag. The good ones were rewarded. Credit Access Grameen's good results came in with a slew of upgrades. The result was a 10.5% up move even in a weak market, even when the markets were choppy. That stock consistently remained higher and ended higher as well. India Mart was one such name as well, 6% higher on the stock. SRF, after some disappointing management commentary, fell 7%. And Tata Communications and margins narrowing on a year-on-year basis, that stock too ended with losses of around 5.5%. The sector that did well today was the metal names, goes without a surprise. Hindustan Copper, Hindustan Zinc, again the principal contributors to that gain. Hindalco and JSW Steel also chipping in with their part in this metals rally in today's session. In some of the newsmakers today, Kalyan Jewellers stands tall on that list. Tall on the list of newsmakers, of course, 12% lower on the stock. UPL was down around 7% yesterday, another 4% gone in today's session. And of course, the two deal-making names, Bazaar Style Retail and Cupid, both of them seeing losses of anywhere between 7 to 9% in today's session. And lastly, stocks that ended at a 52-week low in today's session. It's a long list, and MobiKwik, at one point, the post-listing high of the stock was 700 rupees. It's now down to 200. Anup Engineering was down 6, Orient Pro down 6, and Tata Chemicals too seeing some selling pressure today, 5% lower, ending at a 52-week low for this stock as well.
Some interesting names on your list, Hormuz. Thank you so much for joining in. We'll discuss some of them in greater detail as well. But the other big story has to be the Indian rupee touching a new low of 91.73 per dollar. And that continued to be the case. It did recover. But let's talk about the fall. It has been driven by sustained foreign selling of Indian equities and weak market sentiment. Dealers also say the RBI has been intermittently supplying dollars. Lata Venkatesh is joining us with more details on this one. Lata.
Well, the story is familiar. Foreign funds are selling Indian shares, buying dollars with that money and repatriating it. And that's the same thing. At the rupee was already on that weak wicket where capital flows are not able to bridge the current account deficit. But what has exacerbated it is this kind of risk-off in the last 24 hours across all financial markets that hurts an already bearish asset even more. We did see the Reserve Bank supplying dollars, but when there is a cascading buying of dollars by foreign funds who are marching out, the Reserve Bank wants to preserve the ammunition, so they weren't supplying in huge amounts. Another factor is that month ago contracts entered into the NDF market is maturing, and that leaves a lot of Indian banks in short dollar positions. That creates pressure around 1 p.m. when you have the fixing of the dollar rupee rate for the day. That added to the pressure. So we saw the rupee at its weakest around 1 p.m. There is little to redeem the pressure on the currency. We can only say that at the moment the rupee fall also has strengths. We mustn't look at it as a matter of despair because it makes imports expensive and therefore protects domestic industry from cheap Chinese imports fundamentally. Because while we have fallen in the last year or so about 5.5% versus the dollar, versus the renminbi, the Indian rupee has fallen nearly 12% in the last 8 months or so, or in the past year. Therefore, this has its positive payoffs from the import scenario. Exports also become more attractive, but that, of course, are usually annually renegotiated contracts. Short point, when there is a sudden sharp fall, all these positives kind of pale into insignificance because even those who want to bring dollars don't bring in. Exporters stay back. They want to sell later. Importers rush to cover. And foreign investors also wait to see how much the currency falls. Why would they want to bring in something when the asset is depreciating? So sudden sharp falls don't help anyone. But in the long run, the answer to all the instability or differences in prices is a falling rupee. It's also a solution, but not when it is a sudden sharp fall.
Well, thank you so much, Lata, for joining us and giving us all of the reasons behind the rupee's sudden slide today. But it's a good time to welcome our guests. Today, we are joined by Sudeep Bandyopadhyay, Group Chairman at IndiTrade Capital, and Shrikant Chauhan from Kotak Securities. Thank you so much, gentlemen, for joining us. Well, Shrikant, let me come across to you first. We saw a sharp intraday dip in the Nifty. We've slipped below the 25,000 mark. Where do you see the markets headed from the current levels?
Afternoon, Vivek and Sonal. So yes, Nifty has fallen, and importantly, it has broken the level of 25,000, which is something we can say weak for the market. But at the same time, if we consider the overall technical pattern of the day and the way there is volatility, I am of the view that there is still indecision, and at higher levels, we are going to see furthermore selling or maybe profit taking. So we need to be careful at higher levels. I think the market has shifted its range. We were of the view that 25,500 is going to act as major support for the market, but since last 2 days, the market is comfortably trading below the same, and it has broken the important level of 25. So maybe the market is going to spend some more time within the range of 25,500 and 24,900. But if there is a long-term view, then I think the market has corrected to its important level. And here, if there is a medium to long-term view, then certainly we should look for taking some contra bets of going long at important support levels like 25,000 or maybe 24,900.
Take that point, Shrikant. Sudeep, comment on this. There have been a lot of factors which fundamentally are also impacting markets. Do you think we could continue to see this on the back of those fundamentals, be it earnings, be it what's happening with tariffs?
Obviously, the situation is not very good. There are a lot of headwinds, and the market is navigating that. The global news flow is definitely very, very keenly watched, and it's not at all good at this stage. Corporate results have been by and large okay. I think even the IT numbers, you can say mildly positive compared to the expectations. So I'm not too pessimistic. I mean, what is happening all around us is definitely a matter of big concern. And this massive correction which we have seen over the last few days, I think it's a great opportunity for a long-term investor to start picking up good quality shares. Look, I mean, probably this will continue for some more time, but it is definitely a time for picking up good quality shares from a long-term perspective. There is no two ways about it. Fundamentals, by and large, remain okay. Yes, the raw material prices have gone up in some cases, and the margin may come under pressure in Q4 for some of the companies using metals. But other than that, I think domestic companies should continue to perform well. We, of course, will wait for some announcements which can, probably help the market and the economy. Let's wait and watch for that.
Well, absolutely right. Sudeep, well, one particular stock that did quite well today was Credit Access Grameen. That stock surged nearly 13% in the session after a strong Q3 where there was a turnaround with brokerages such as CLSA, HSBC and JM Financial upgrading the stock. Gaurav joins in with a report card of Q3 as far as credit access is concerned.
Well, yes, if you look at Nifty and overall the market, it was actually a difficult day. But one stock which actually stood strong was Credit Access, and this was on the back of the numbers. And the reason being that if you look at the net interest margins, we saw 60 basis point of increase on a sequential basis. And at the same time, second and the biggest point which market took in a very positive way is the credit cost. Now that has declined almost by 300 basis point on a sequential basis from 8.5% to around 5.5% levels. Now what are the reasons? First is that if you look at the MFI portfolio, they are seeing the stress is actually falling down. In fact, the collection efficiency that is actually improving. At the same time, management remained confident. They said that credit cost is going to be in the range of 4 to 4.5% next year, which means there is a room for further decline in credit cost going ahead, although in fourth quarter it may remain stable. Other than that, the ROAs, they are expecting ROAs also to increase to around 4 to 4.5% levels. Again, there is a room for development because currently the ROA stands at 3.5%. They are also confident on the growth guidance. They have reiterated their growth guidance of 20% for FY27 versus what they reported as 8.5% in this quarter. So definitely, all in all, a very good set of number. Management remained confident, and after that we saw brokerages also showing some kind of confidence. We saw HSBC and CLSA actually upgrading their target price as well as a rating for the stock to buy. And let's also not forget about the valuation aspect, because if you look at valuation for Credit Access Grameen, although it trades at 2 times price to book value, but it is still lower than their peak valuation of 3 times that we have seen in December 2023. Let's also not forget about some of the stocks which will be in focus on the back of the MFI recovery that we have seen in Credit Access Grameen, and these will be in the likes of 5 Star, Spandana Spurti and even Bandhan Bank, because they have not reported numbers yet. But given that Credit Access Grameen has shown some kind of improvement in the asset quality, we may see some uptick in these companies as well. But all in all, in terms of good numbers, we saw Credit Access Grameen gaining in trade today.
Okay, yes, some of these stocks which bucked the trend, so those are on our radar. Kalyan Jewellers was the other stock which slipped nearly 15% in trade on heavy volumes. Remember, Motilal Oswal Midcap Fund holds nearly 9% stake in the company, while the promoter pledge remains nearly 25%. Let's get in Mangalam to tell us what really happened. There have been some management changes as well at the fund holding stake. Mangalam, tell us more.
That's right, Kalyan Jewellers is down in double digits in today's trading session, down for 8 straight trading sessions, and currently down 16% in this week, over 35% from its 52-week high as well. There are 3 reasons which are, plaguing the stock right now. The biggest one, of course, is that this decline has been caused by perhaps some fears around one of its largest institutional holdings, and there being, a churn at the top, Motilal Oswal, where Niket Shah has been internally reshuffled in the organization itself. Motilal Oswal has 9% stake in the company, which has actually increased from 6% same time last December to around now in December 2025 as well. If you look at the other funds as well, while Franklin continues to hold its stake, Sundaram has pared its stake, as has the government of Singapore. It's important because remember, the promoters own sub 63% stake in the company, just below that, but they have nearly 25% of their stake pledge. So with this big decline, will this pledge come up for a little more, or will there be further addition to that pledge or not? has a bit of a concern on the stock. The other factor that we're looking at, retail investors own nearly 6% of the company. This too is a number that has increased from 5% last year, and the number of retail shareholders have increased by 1 lakh. So all these factors make it extremely important for one to track Kalyan Jewellers and the trajectory from here, especially given the underperformance in the stock, despite the strong fundamental performance that we're seeing in the jewelry sector, thanks to gold and silver prices, along with the demand for jewelry, which is more affordable and accessible in nature as well. The third quarter updates for the entire pack, no real questions, but this technical factor has the stock really pressured.
Well, thank you so much, Mangalam, for joining us and highlighting and explaining all of the reasons why Kalyan Jewellers has been under pressure for so many continuous sessions. Well, Sudeep, coming across to you, wonder if you have a view as far as Kalyan is concerned. Clearly, factors beyond fundamentals actually impacting the stock currently. Do you feel it now presents a good value proposition, especially if you're looking at it for a medium or long term, or within the jewelry space, which is your top pick?
Well, within the jewelry space, I have been bullish on Titan for a very, very long time, and I continue to maintain my view from a long-term perspective. But I also do like Kalyan, and I have been mentioning about Kalyan for quite some time as well. And I believe this correction is definitely an opportunity for picking up. May not be, tomorrow itself morning, but just wait and watch and start picking up Kalyan. I think it's a great opportunity. There is absolutely no problem with the fundamentals. Their model of using franchisee for expansion into North India where the margins are higher, West Asia expansion, again through franchisee route where the margins are better, increasing the studded portion in the overall mix, again a margin accretive. So there is absolutely no problem. I think this is very correctly pointed out by Mangalam, technical issues which has been plaguing the stock, and that's why we have seen this sharp correction, but definitely a great opportunity considering what's happening in the gold and silver market.
That point, Sudeep. Shrikant, quickly, if you can tell us anything from the consumption space or the jewelry space that you like technically?
So yes, from the jewelry space, if we consider Kalyan Jewellers, then it has broken important level at 400. It was around these 400 levels in the month of March 2025. And after such a long period, when the stock has broken this level, one thing is very clear that the stock is heading lower, and we may even see the levels of maybe 333 sort of levels in the near term. But if we consider other stocks like Muthoot Finance or Titan, there the relative outperformance is very, very high, and we are expecting furthermore upside from Titan as well as Muthoot Finance. So ideal strategy should be to look for adding them on every dip instead of adding at current levels in one go. So Titan, which is around 4,000 sort of levels, there we are of the view that the stock is going to consolidate some more time within the range of 4,000 and 4,200, but eventually the stock is heading for the levels of 4,500. That's my view.
Well, thank you so much, Shrikant, for your view. And with that, we thank you both, Sudeep as well as Shrikant, for joining us, giving us your view on the markets, fundamentals, as well as technical levels. Well, with that, it's time for a quick break. We'll get to the top corporate voices, along with the key market events to watch out for on the other side.
Welcome back. You're still tuned on to Markets Forward. Let's get in some corporate voices of the day. Persistent Systems Management said a one-time impact from the new labour code weighed on profits during the third quarter. The company expects to remain in the 16 to 17% EBIT margin range in the near future. The management also said that it is confident of achieving the goal of $2 billion in revenues by March 2027.
Supreme Industries Management has maintained its FY26 plastic volume growth guidance at 15 to 17% and overall volume growth guidance at 12 to 14%. However, the EBITDA margin guidance has been cut by 100 basis points to 13.5 to 14%. The company added that prices have begun rising slowly but steadily since January 2026.
Vikram Solar said this recent dip in EBITDA is temporary and expressed confidence